profitability of U.S. companies is unlike anything else that's available in the global equity market.
I'm not necessarily saying we're sitting at like 2000 dot-com bubble type overvaluation, but we look a little bit over our skis.
There will be a lot of unpredictability in this next cycle.
There will be increased volatility. I think that's what we need to be mindful of.
The United States still is going to outperform both in terms of economic growth and equity markets, yes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to the start of one of the last trading weeks in 2024. All eyes are very much focused on Wednesday's inflation data as the forward visibility into 2025 gets murkier and murkier. Right now, stocks are basically range-bound, coming after a third straight weekly gain, possibly on track for the best performance for equities in the U.S. going back to the start of the 21st century. Right now, the focus very much on the commodity sector with oil prices rising after turmoil in the Middle East. John Ferro is on a well-deserved break this week. Joining Anne-Marie and myself is a tireless Danny Berger. And Danny, the key question for a lot of people right now is just how high is the bar for these gains to keep going?
Well, with so many tail risks out in front of us, as you mentioned, the market is only concentrating on what it can see. And what it can see is Fed cuts coming this month and the hopium of pro-growth policies from a Trump administration. That latter one, we won't know until sometime in more than a month at the earliest. So for now, we concentrate on the cuts. The only thing that could derail that is CPI coming this Wednesday.
Which we do get on Wednesday. But before that, we have basically the world falling apart. Anne-Marie, over the weekend, we had the Middle East completely overturned with the Syrian government, the Assad regime, being toppled in 11 days. Just how much does this rearrange the politics in one of the central hotspots of hot wars that we've seen over the past couple of years?
Well, the speed of which Assad was toppled, fleeing off to Moscow, looking for some sort of place to seek refuge, was absolutely stunning. The key question inside Syria is who's actually going to govern. This has multiple enclaves and different spheres of influence around the country. The bigger question for the region is what does this mean for Russia and Iran that have strategic influence in the country and use it for their strategic development, whether that's having be able to have ships and access in the Middle East, or whether or not that's able to use transports from Iran through Syria to some Iranian proxies. That is the big question. And who is going to be able to basically fill this vacuum? The United States says they do not want to get involved, but over the weekend you did see them hit ISIS targets.
And it just emphasizes how regime shifts happen in clusters. We see this throughout the world, maybe not to the extremities that we're seeing in Syria, but turmoil in France, turmoil in Romania over the weekend, turmoil in South Korea. At what point does it stop being, hey, this just reemphasizes how great U.S. assets are, to, wow, the entire world order is being upset, and America is part of that world order?
And that's actually a point that people have been making, that basically incumbents have been overturned time and time again over the past couple of years around the world. And it comes on the heels of inflation, on the pandemic, on a real widening in the gap between wealthy and poor, which is a reason why Wednesday, when we get CPI data, it is going to be so important. It'd also be important to understand what kind of fiscal dominance there is in the United States with a series of bond auctions. At the same time, you are seeing this morning gold prices surging on the heels of potentially central bank buying from China and the stimulus package over there. Coming up this hour, Jeff Yu of BNY following the S&P 500's 57th record of the year. Terry Haynes of Pangea Policy on the fall of Syria's president, and Neil Richardson of ADP, as Trump says he has no plans to replace Fed Chair Jay Powell. We begin this with stocks at all-time highs, just coming off that this morning following their third straight winning week. Jeff Yu of BNY is cautious, writing the rally up in risk assets in the hope that U.S. growth continues regardless of new U.S. administration shifts in fiscal and trade ahead seems too sanguine. Current volatility in FX markets is a warning sign for the relative calm in fixed income and equities. Jeff joins us now. Jeff, are you going to be one of the lone voices pushing back against the momentum that everyone else thinks can just keep going into perpetuity?
Hi, Lisa. Well, I'm not sure if it's a lone voice, to be frank, but just looking at valuations, we're talking about valuations for all US assets right now, not just equities, but also in FX, and you can do that using volatility. As we mentioned, that's where we see absolutely the need to be cautious. And the reason is we want to look at fixed income right now. Curve steepening, that's what we're looking for, given the fiscal side and other aspects of the US economy on the inflation side. And we remember what that did to equity markets in 2022. So risk, certainly more risk needs to be priced in.
Jeff, a lot of people are talking about how markets seem to have priced in all the good news, but not the bad news from potential Trump policies. And what we heard from Donald Trump in his first interview over the weekend on NBC since getting elected president was that he wanted to keep a certain status quo, at least with Jay Powell of the Federal Reserve, but was doubling down on the idea of tariffs. What did you make of that? And where do you think the risk is mispriced?
So I think he's trying to be as balanced as possible. But where do I think risk is mispriced? Again, I go back to the Treasury curve. One thing that wasn't talked about by either side during the campaign, it basically is the US's fiscal situation. We've had so much inbound incoming from France, the sustainability of that. But if you look at the OECD's forecasts, which country will have an even worse fiscal trajectory up ahead than France and developed nations? It's actually the US, right? So I get it. It's the world's reserve asset in terms of US treasuries. But will foreign buyers continue to play ball? They will probably need to deal with tariffs at some point. On the other hand, they're expected to continue to fund the US deficit. I think that's where, and looking at our data, it's not that they're selling right now, but I think enthusiasm may not be as strong as in the past, and that's what we're wary about.
Jeff, the weird thing about that, though, is that conversation was had in both the run-up to the election and the immediate aftermath of Donald Trump's election, of his winning of the election. And you saw that rise in Treasury yields, but it reversed itself, and we're basically flat with where we were at the election. Why did we lose that focus? It had been a part of the conversation.
So the view is Tina, right? So there is no alternative. But now let's take a step back. Is there an alternative right now? A fiscal alternative? I'm not saying the dollar's going to be displaced. I don't think that will happen. But in terms of supply, let's look at market dynamics. If Germany gets rid of the debt brake, look at China's commentum today. Both these countries, they are going to push on the fiscal lever, which is something what the market has been looking for. So if there's going to be fiscally driven reflation in Germany and China, then you actually do have an alternative. You want to fund that healthy reflation, that healthy growth that you could see amongst the exporting nations. So I think, that's where the US perhaps should not sit on its laurels. People will continue to buy US treasuries, but if there's reflation elsewhere, then deficits will come down automatically almost. So there's just less dollars available from international investors to fund US Treasury assets as well. So again, look at the curve and let's see where the dynamics are going to be.
Even so, people have pointed to the two countries you're talking about, especially in Germany, especially in France, as having political upheaval. And political upheaval throughout the entirety of the world, just reinforcing US exceptionalism. Maybe this gets back to Tina. Is what you're talking about enough to undo the narrative of US exceptionalism?
Well, certainly the case in talking to EU clients right now. If you're relying on EU maybe to push things from within, that will take time. But the Draghi report, has laid out the broader timeline for something to happen. But also, if the EU recognises that on the external side, there will be more challenges up ahead, that may accelerate change as well. So this is perhaps taking a 1 year, 2 year view. But if there is going to be a path towards change, and crucially going back to the US, looking at where valuations are in the dollar, in US equity markets and also in treasury markets relative to the deficit, I think people will begin to actively look for an alternative rather than just say, if it ain't broke, don't fix it. I'm going to stay with US exceptionalism. I still believe in that story, to be clear, but I think people will want the right level of valuations for that as well.
Do you still think we're going to see parity at some point between euro-dollar?
Absolutely. So I'm going to absolutely stick to that view. We will go through parity, I think, at some point in the next 3 months or so. Right now, again, looking at our data, euro-dollar is quite short. Our clients are overhedged in European assets. I think that's why you saw a bit of a relief rally last week as well. All the quote-unquote bad news is in. But once we go through parity, that's where I think we need to revisit US valuations. It's not about the euro being too cheap. It's about the dollar being too expensive.
Jeff, let's also talk about China. You mentioned it. And today we have this change of stance in monetary policy, moderately loose from prudent, first time in 14 years. How much is this driven by the incoming Trump administration and potentially the tariffs that they're going to place on Beijing?
I think that's featured into overall policy making. But let's take a step back here. Looking at China's export strategy, I look at export prices are not exactly rapidly expanding, right now. So if you look at overall prices, price expectations, that's something that the PBOC needs to lift. So even without a change in the US administration or US trade policy, and to be frank, there hasn't been much change in any case, or won't be much change from Beijing's point of view, this is necessary from a domestic perspective. So the target audience perhaps is less DC, it's more the domestic audience, and that's much needed, especially as we head into next year, into the MPC session. So this is where I would focus on Chinese equities. And also I would add, last week, when Chinese 10-year bond yields went through 2%, I think that may have triggered some rethinking within Beijing as well. We need to lift expectations right now.
I'm looking at Alibaba shares right now, and they're up about 7%. To your point, very much domestically focused. Jeff, you also see oil prices higher, yes, because of turmoil in the Middle East, but partly because there is this feeling that renewed demand from China could boost prices there. Also, an increase in gold prices. At what point are you pushing back and saying, most of all, this is going to be domestic and it's not going to trickle out into necessarily commodity markets and nearby currencies, given that this really is insular?
So what was unique about today's statement was it really had a positive message regarding household consumption. So if it is household consumption, household spending, I would say that's good from the US's point of view in terms of reducing deficit if China buys more services. I'm not sure there is a case for really pushing on real estate again or pushing on investment growth again, certainly not compared to, say, 2009, right? So if we compare to the previous episodes of mass expansion, because that tends to leave debt issues. So I can just say this is a non-negative for commodities, but is this really focusing on the Aussie, on the South African rand, or oil prices, or lithium prices even in general? I would probably temper my enthusiasm on that.
Which is the reason why people are focused very much on the United States yet again to see whether it can continue to grow at a fast pace and whether we see any significant policy shifts from the Donald Trump administration. This week is a significant week following non-farm payrolls on Friday. We have CPI coming on Wednesday. That's the main event. We also get PPI on Thursday and jobless claims. The ECB on Thursday with that decision, which is going to be a really fraught one. But we also get auctions all through the week. I won't run through them. But, Jeff, from your perspective, how much has the risk shifted to an overestimating inflation and, frankly, for people maybe being surprised to the upside and the Fed not being able to do enough? How much has that shifted and away from the jobs picture?
So I think overall, looking at the Fed right now, so I don't think we can rule anything out. It's less about shifting away from inflation. So looking at the downside picture, but at the same time, it doesn't preclude, let's say, a big push, towards easing as well. So no more strong inflation doesn't mean strong disinflation. Whereas if I look at the ECB, there is a much larger risk to the downside. This has been highlighted in the PMI reports, where you have manufacturing weakness spilling over into the services side, given the services has been driving inflation within the Eurozone. That's why there is a downside risk. So I still wouldn't rule out 50 basis points by the ECB as a tail risk. We might get 50 basis points. Actually, I think we should get 50 basis points from the Swiss National Bank this week as well. But that will tell you that the major downside risk clearly is in Europe right now when it comes to prices.
And that would be 125 basis points of cuts this year from them if that were to transpire. Jeff Hu of BNY, thank you as always. Right now, let's check in on what's going on outside of just the focus on markets. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. For the first time in more than 50 years, Israeli ground forces have crossed into Syria. Israel's foreign minister said they struck a chemical weapons and missile storage facility in Syria, calling it a, quote, preventative measure. With Syrian President Bashar al-Assad's government now toppled, Israeli Prime Minister Benjamin Netanyahu says this may help advance a deal to release the hostages held in Gaza. Meanwhile, UBS CEO Sergio Aramati says the incoming U.S. administration's potential move to raise tariffs on trading partners could increase risk in financial markets next year. He spoke to Bloomberg earlier today in Abu Dhabi.
The acceleration of geopolitical events coupled with potential escalations on the macroeconomic front, tariff, protectionism, it's definitely something that has to be watched. On the other end, we still see consumers and the economy quite resilient despite all these challenges.
Aramati also said he's expecting to see continued volatility next year and is advising clients to be well diversified. And big news in baseball, Juan Soto is heading to the New York Mets. The 26-year-old slugger signed a 15-year deal worth $765 million with no deferred money. That's the largest signing in pro sports history, topping the blockbuster 10-year contract Shohei Ohtani signed with the Dodgers last year. The Soto sweepstakes had been in full swing for weeks, with a number of big-name teams in pursuit, including the Boston Red Sox, Los Angeles Dodgers, and Yankees, who he helped bring to the World Series this past season. That's your Bloomberg brief. Lisa?
Thank you so much, Yahira. I just want to really emphasize that the Mets did get Juan Soto away from the Yankees, and they probably will do a lot better.
Mr. Wonderful, how did we lose him? I'm so upset this morning.
It was a price tag that was worthy, I suppose.
Yeah, Yankees can buy a lot of other people. Maybe not another Juan Soto, but, some other problems they have.
Or not. Or maybe the Mets will just be a lot better. Up next, Assad's regime falls in Syria.
It's a moment of historic opportunity for the long-suffering people of Syria to build a better future for their proud country. It's also a moment of risk and uncertainty. As we all turn to the question of what comes next.
That is up next in terms of a conversation. You're watching Bloomberg Surveillance. Basically range-bound after a third straight weekly gain with 57 all-time highs on the S&P 500. Right now, not a lot of drama ahead of the CPI print on Wednesday and Friday's ECB rate decision, but crude up 1.4% as turmoil in the Middle East boils over. Under surveillance this morning, Assad's regime falling in Syria.
At long last, the Assad regime has fallen. This regime brutalized and tortured and killed literally hundreds of thousands of innocent Syrians. The fall of the regime is a fundamental act of justice. It's a moment of historic opportunity for the long-suffering people of Syria to build a better future for their proud country. It's also a moment of risk and uncertainty. As we all turn to the question of what comes next.
Here's the latest. U.S. airstrikes hit dozens of Islamic State targets in Syria after rebel groups overthrew Bashar al-Assad's government, ending 50 years of party rule and sending shockwaves through the entire region. Terry Haynes of Pangea Policy writes, Assad's rule wasn't in any way positive for Syria, the region, or geopolitically, but new Syria is a void into which many competing geopolitical interests will pour things. And Assad fell quickly, perhaps too quickly, for the rebels or anyone else to be prepared. Terry joins us now. Terry, you wrote a phenomenal note over the weekend that really highlights the level of uncertainty and what could potentially happen. What do you think the U.S.'s involvement is right now? Because we did hear them say we shouldn't be involved. Trump has said he thinks the U.S. should not be involved, and yet the U.S. has been bombing select sites tied to Islamic State.
And yet we will be involved. Good morning, Lisa, and everybody. And yet we will be involved, and we should be. I think the option is to be involved and help shape the future of the Middle East, and we've been involved in that since after the Second World War, or to recede, in which case the opportunity for a void and pressure on allies, whether they be Israel or Saudi or Jordan, become much greater. So I think the American involvement here is here to stay, and America sees the opportunity, frankly, as does Israel and others, to assert a maximalist pressure. The choice here is whether we're going to have a Middle East, and kind of one of the cruxes of the world in a hot conflict that is more controlled by moderate Arab states and or by Iran and others. And so the United States needs to stay involved.
Terry, when you say exert maximum pressure on who? Is this on Turkey? Is this on Iran?
Yes. In different ways, sure. Turkey is clearly a winner of this already, in the sense that it gets to exert more influence in Syria, and we'll see how that push for influence is taken by the victors in this conflict. But you also have a situation where Iran thinks it can benefit, even though clearly its nose has been bloodied here, thinks it can benefit by stoking the void that I talked about. And that's something that the United States and its allies have to push back against also.
President-elect Donald Trump made it very clear over the weekend, saying the United States should have nothing to do with Syria. This is not our fight. Let it play out. Don't get involved. Do you see the same level of involvement during the Biden administration? Right now, what we see being transformed over to the President-elect Trump and his 2.0 administration?
Well, let's put it this way. President-elect Trump has been very clear about his continued support for Israel, his continued friendship and desire to be helpful to the Saudis. Let's remember, Trump has a legacy here in the Abraham Accords as well. So for those three reasons alone, I think what you're going to see is a continued involvement in the region by the new administration.
The period, though, from when Trump was elected now heading into his inauguration, Terry, you point this out in your notes to clients, this idea that it has been dominated with foreign policy for the president-elect. And it might only get worse. What does that mean for Trump and this market's hope of getting some of those domestic policies through, of accomplishing that, when Trump's agenda this far has been dominated with geopolitics?
Well, I think the Trump's agenda has been dominated by geopolitics for a very good reason. I mean, there's been an awful lot of it, right? And it continues without let up. So it's to his credit that he's focusing on it so much and so well, particularly when the outgoing administration seems to be a little back on its heels by comparison. But what I think is going to happen here is that things will proceed on two tracks. The idea that you have tax cuts and that you deal with the tariffing and all the rest, I think proceeds largely on one track. The pure foreign policy proceeds on another track. And frankly, the tariffing becomes kind of a bridge between the two, since tariffing has now long been a tool of geopolitics as much as anything else.
Well, some of those concerns of what might come to the U.S., as you say, Terry, it might be forgiven because of what's happening globally, that U.S. exceptionalism can kind of reign on because of the discontent around the world and the governments being overthrown. At what point, if at any, does that stop? That doesn't necessarily act as a distraction, but it all involves America, too, and investors' likelihood of continuing to buy up American assets.
Sure, it's a real hinge right now, and the big question, I think, is the extent and how and whether markets tire of wanting to continue to support the United States when you've got serious problems with fiscal spend, with debt and deficit. I think what the president's going to want to do, and this is part of the reason why he appointed Scott Bessent to be Treasury Secretary designate, is he's going to want to make a move in the markets towards wanting to curb debt and deficit at some time in some way. That may be more style than substance, but at the same time he's going to want to make a move in that direction to reassure markets at the same time that he's pursuing his domestic tax policies.
Terry, is that basically the takeaway from the interview that he did yesterday with ABC?
That
he wants to maintain the status quo.
In where, Lisa?
In the markets, basically, with respect to keeping Fed Chair Powell and not trying to really rattle anyone with respect to going after political enemies, but also not really giving any sense that he won't.
Oh yeah, absolutely. Trying to rattle, The reason why I've always thought that the Powell thing was a non-starter, and yesterday I think I was proven right, is that you can't rattle the Senate, who you need to implement policies, and you can't rattle the markets, who you need for confidence domestically and abroad. So the whole Powell gambit's a loser from that broader perspective.
Thank you so much. Terry Haynes of Pangea Policy. And it was an NBC interview that Donald Trump was speaking on, and it was the first. And honestly, I think that was probably my takeaway, was that he wasn't really interested, Emery, in rattling anything or shaking anything up in a material way.
And we have to remember, he's still getting his cabinet picks together. We're still waiting on a number of individuals that he still has to announce. On top of that, can some of these individuals, when we're talking about Syria, does Tulsi Gabbard still have this ability to get confirmed after what we're hearing what's going on in Syria? Someone who went down and met with Bashar al-Assad when she was in Congress. So it's going to be a very interesting week in terms of that on Capitol Hill.
Yeah, especially at a time where you've got some big personalities that are starting to already clash within the cabinet. Coming up, more on what's happening with China. Bloomberg's Enda Curran as China signals looser monetary policy and a real shift given the fact they want to support domestic consumption. This is Bloomberg. There are 3 more trading weeks left in 2024, and what we can see is just that momentum continuing even on days like today, where basically it's soggy, range-bound, not doing much following 3 straight weeks of gains, 57 record highs. Today, we can't really find direction, but what is notable is that last week was driven by the tech names. This week seems to, at least if you could take anything from the pre-market trading, is being driven by small caps. In the bond space, really the key shift here is going to be how much does CPI shake some of the complacency in markets that the Fed can continue to cut rates and even lob a few rate cuts into the mix next year. Danny, we have across the board 2s, 10s, and 30s kind of going nowhere. Again, just around the edges given some of the volatility that we've seen. But given the fact that non-farm payrolls was a non-surprise, it really does up the ante on what we're missing in terms of stickiness in CPI.
And the Fed communique, what we've heard from different Fed officials has been inflation's coming in, and that's why we can cut. They've kind of shifted away from saying the labor market is weak. The issue is that they're in a blackout period right now when we're going to be getting the CPI data, PPI, and import prices. What happens if it's hot? Is it another round of kind of massaging the message through their various favorite media outlets?
Yeah, I was going to say, just look for some articles maybe in the Wall Street Journal, and maybe we'll get a sense. But it comes at a time where we hear about a policy mix that's going to be front-loaded with tariffs and back-loaded with some of the potential stimulative aspects. And I do wonder, we do have auctions this week. I just want to point out, Anne-Marie, and I know that you're focused on them just as much as I am. $58 billion of 3-year notes tomorrow, $39 billion of 10-year notes. And what was that? $22 billion of 30-year notes on Thursday. How much is Trump aware of this and really focused on making sure that yields are contained?
I think he's very aware, but in that interview with NBC, he once again reiterated that there will not be cuts when it comes to Social Security, when it comes to Medicare. When you look at the spending of the U.S. budget, that's like the biggest slice of the pie. On top of that, what else to your bond auctions is the U.S. spending a ton of money on, more than ever, bigger than the defense budget right now, paying off our debt, net interest payments. So he's very aware of this, and so are some of the fiscal policy hawks' his administration.
Which maybe is the reason why he's not so unhappy with Jay Powell, given the fact that he has that dovish proclivity. Meanwhile, in the commodity space, you can see oil prices ticking higher, and this comes even with some of the glut that we're seeing from the likes of Saudi Arabia, OPEC plus countries. And this comes maybe because of the turmoil that we're seeing with the fall of Bashar al-Assad's regime. You can see Brent crude up about 1.25%. Crude traded on the NYMEX 1.4%. A real question here about how much this is geopolitical and how much this has to do with China. Under surveillance this morning, U.S. airstrikes hitting dozens of Islamic State targets in central Syria yesterday. President Biden warning that Bashar al-Assad's fall from power could open the door to a resurgence from Islamic extremism at a time where there seems to be a void in U.S. leadership.
Right, and there's going to be a void in leadership when it comes to Syria, and that is why there is concern about this reconstitution of ISIS. We heard from General Kurilla when CENTCOM put out a statement last night, and they said there should be no doubt we will not allow ISIS to reconstitute and take advantage of the current situation in Syria. All organizations in Syria should know that we will hold them accountable if they partner with or support ISIS in any way. When Terry Haynes says the U.S. says they're not getting involved, but then again, they are involved, it comes down to this. Whether it's Biden, whether it's Trump, neither of these individuals want to see a reconstitution of ISIS.
Well, that's the thing. A lot have pointed to Donald Trump's post over the weekend saying this is not our fight. Do not get involved in Syria. But I would remind everyone that in late 2018, he said that the U.S. would be leaving Syria. What evolved after that was Congress essentially coming out over to him and saying we can't leave Syria. There still is ISIS in Syria. The U.S. has to be there. And 11 weeks later, Trump reversed course and said we are going to be there. Maybe eventually we'll pull back and only have 400 troops there. There are still, according to the Department of Defense, 900 troops there. So even what Trump wanted to do and what he said he wanted to do didn't happen to the full extent. So it's just a bit of caution to look at what Trump says and to think, will this really happen? Will this not be the America's fight?
And this isn't just Syria. This was the strategic playing ground of Iran and of Russia. So a real question here about how that evolves. We'll have more on that in just a second. Meanwhile, thousands of Volkswagen employees are preparing to walk off the job today if management and labor leaders can't break a stalemate over cuts at the car maker's namesake brand. It will be the second time workers have gone on strike this month. The union says it's ready to escalate protests if the two sides fail to make progress in this long chain of pressuring European auto manufacturers. Danny.
It's a rock and a hard place for VW. I mean, they were caught by surprise of Chinese EV. Demand is weak. But at the same time, this is nearly 100,000 workers. I was looking at it. Germany has 300,000 workers. That means a third of workers in Germany are willing to go on strike. And if it's a stubborn VW that says, look, we have to make these cuts in order to survive, will it be that stubbornness that eventually undoes them? There is a real willingness for these workers to walk out.
Well, this does feel like a little bit in the end of a negotiation where you escalate to de-escalate, because the lead negotiator for workers is talking about the fact that they are trying to get something done before Christmas this year. Olaf Scholz giving an interview over the weekend talking about that VW should not shut down factories. So it's not just the negotiators, it's also going to be the political pressure on VW to make sure that they shore up these jobs. Olaf Scholz says closing locations, quote, would not be the right way because of poor management decisions that added to the difficult situation. I think VW and all of these automaker executives would say, well, actually, it was the policymakers that set the tone of where we should be going and told us to produce cars that right now there's just no demand for.
Well, that's what I was going to say. I mean, in this war of finger pointing, how much are we looking at a VW that has the capacity to do more, to give more, or some of the auto manufacturers in Germany that are flat on their back and can't really afford to compete with the policy mix that they're facing off with?
Well, it's the policy mix coming down the pipe from the top when it comes to the German government. And then on top of that, it's the fact that they are dealing with the onslaught of cheaper cars that are coming in from China. So a lot of this has to do with policy shifts, even less so more than what is going on the factory floors.
Talking of China, China's top leader is planning to loosen monetary policy and expand fiscal spending next year. The move by the Politburo marking its first major shift in stance since 2011 is coming as China braces for a second trade war with President-elect Trump, and also facing off, Danny, with some pretty negative data showing deflation in goods and more disinflation in the consumer price sector.
I thought it was really interesting, that conversation we had with Jeff Yu moments ago. How much of this is for the domestic audience versus the international audience? Because when this first started, there'd been a lot of commentary coming out of this meeting saying that this is China saying we are prepared for a Donald Trump. Before, it had been incremental policy. This time it looks to be a package, something this market had been waiting for. Is this China saying we are prepared for you, Donald Trump, and we have the firepower necessary to combat any tariffs you might put onto us?
Let's get someone who could answer that question. Bloomberg's Enda Curran stops by, at least virtually. And thank you so much for being with us. What's your take on exactly what the motivation is behind this policy shift?
Well, if you take it at face value, this is the biggest policy shift in China in years. Like you mentioned, there's tweaks of language throughout the statement that came out of the Politburo. This is the top policymaking body in Beijing. They're talking about they now want moderately loose monetary policy. That's the shift, putting monetary policy back to where it was during the global financial crisis. There's language in there around wanting to spend more. There's language in there around extraordinary counter-cyclical measures. That's jargon for, willing to pull whatever levers they can to get things going. And there's also talk in there about pushing through reforms and getting consumers to spend more, which of course would be music to the US Treasury's ears. So on paper, it signals that China is readying for the potential fallout from the Trump trade war. They're signaling that they do have tools. But as you mentioned at the start as well, let's not forget, they're coming from a pretty low base. PPI in deflation, consumer prices at zero. There are plenty of reasons why China needs to stimulate its own economy without a trade war anyway.
Do you have a sense of what they're looking at doing when it comes to fiscal, right? Because we heard about the monetary policy levers and taking a more accommodative stance. The fiscal remains a real question mark, given that Xi Jinping's regime has really been averse to putting money directly in the pockets of households.
Yeah, this is where it gets into kind of the devil in the detail. As I say, face value, headline, takeaway here is it's a significant change of tone and language from the authorities in Beijing. This is what the world has been waiting for the past couple of years. But we don't have the detail. There is an important meeting later this month called the Economic Works Conference when the officials will gather and nut out the economic policy detail. But we won't get the figures from that until maybe the March NPC, the National People's Congress. That's when we get the growth target, and that's when we might get detail, to your point, Lisa, about what kind of fiscal measures are they talking about. Now, we do know, though, at the central government level, the government does have room to borrow and spend. I mean, that's clear. It's at the local government level is where the fiscal stress is. So a lot of analysts will say China has room to spend money. It's a question of, do they have the appetite and political will to do so?
That's the thing, Enda. There have been lots of false starts in China before with hopes of stimulus. What are the signs to look for to see whether this is the case, whether this is another false start, or whether this leads to actual concrete action with the details that you're talking about?
Well, I think we know that the starting point for China is the economy has been struggling now, say in the post-pandemic period. The real estate sector has been in a slump. Consumers have been hitting the potential that they could be. The export market is roaring now, but manufacturing has been hit and miss over the past few years in general due to the overcapacity story. So there's a case, first and foremost, for China to deliver support for its own economy on its own terms, and that's why there's an expectation there is something coming down the pipe. They have been slowly ratcheting that up. But then, of course, you step back and look at the global stage. They now know the outcome of the US election. We know President Trump has a very hawkish trade policy. He's already threatened tariffs on China since winning that election. So they know they have to brace for what's coming down the pipes, and they have to get their house in order. It takes time to get their bureaucratic system in order and to get the agreement in place to pull the levers that they need to if and when they have to. But it's also a signal, of course, to the rest of the world that China has the fiscal spending power needed to revive the economy. And I think that's probably one of the key takeaways. They're bracing for the trade war, and they're ready for it.
Well, they know it's going to be Donald Trump sending something down the pipe, Enda, but we don't know exactly what the details of it will be yet, whether it's blanket tariffs, whether it's targeted. How much is China likely to hold back until we get the details, until we get specific policy proposals from Donald Trump?
Absolutely. Look, there's a kind of a view out there among the analyst community that China will play nicely to begin with, hear out President Trump, see what he has to say. There's a view that maybe it all kicks off with returning to the initial trade agreement, the so-called Phase 1 agreement, before they get into any rounds of new or punitive tariffs. So China is flying blind like everybody else to some extent. But at the same time, though, there are two things going on. This is China saying we can support our economy if necessary. And China has also been making clear that they can respond and retaliate where necessary. We saw the response to the latest semiconductor restrictions last week with the export controls on those critical minerals to the US, for example. There are other areas where China can make it awkward for US companies doing business inside China, and awkward for, we'll say, the agricultural sector in particular as China sources new markets. So I think China is making it clear it's getting its house in order for whatever does come down the road. If President Trump comes to the table and does a deal, they'll do a deal. But if it becomes quite a tit-for-tat trade war, high tariffs and all the rest of it, they're going to cushion their economy. And, of course, they have got some tools or some levers to pull themselves in response to what the U.S. does.
Well, speaking of those levers, Enda, we're getting a headline that China is probing Nvidia on suspicion of anti-monopoly law breaches. How many more of these are we going to see? Are we already in a tit-for-tat between American companies and Chinese companies?
Well, China has made it clear before that they will respond to any US-led trade war. They did so the last time around, and in particular, they can make life difficult for US companies doing business in China. And there are different ways they can do that, whether it's inspections, whether it's regulatory oversight, permits, the likes. There are levers China can pull, and this is something that's been a consistent theme over the past few years. And I think, again, if we do go down the road of a trade war, so to speak, between China and the US, it won't just be the US that has trade levers to pull. China will be responding.
And to Karan of Bloomberg, thank you so much for that. And as Anne-Marie just mentioned, we did get this headline that China is probing Nvidia on suspicions of anti-monopoly law breaches. It's according to China's Central Television. And we're seeing Nvidia shares down 2.3%, waiting for more details to understand exactly what goes into this. But AMH, it's a real question here of how much China wants to crack down on U.S. companies while maintaining access to some of the products that have generated a lot of the AI fervor.
Exactly. Nvidia sells these chips into China. China. And what this headline may be is that the CCP is just trying to hit back on U.S. companies because of things like export controls that happened under the Biden administration, tariffs that maintained in place from Trump to Biden, and then the expectation that maybe there's going to be a whole lot more coming down the pipe with President Trump in the White House.
Well, the thing is we've talked about this. What does President Trump care about as a barometer? It is the equity market. If you want to upset Trump, you go after literally the biggest company in the S&P 500, the one company that has the potential to move the overall market. I think this is a space to keep watching.
Well, we will bring you more details as we get them. Right now, let's get an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. South Korea's Justice Ministry has banned President Yoon Suk-yeol from traveling overseas. The ban coming as multiple investigations are underway following the embattled leader's brief declaration of martial law. He survived an impeachment vote over the weekend. The Kospi benchmark stock index closed down 2.8% today, and since the martial law declaration last Tuesday, it has fallen more than 5.5%. Meanwhile, the search continues for the suspected gunman in the killing of health insurance executive Brian Thompson. Here's the latest. The New York Police Department released new images on Saturday of the suspect in a taxi that's believed to have taken him to a bus station. From there, police believe he boarded a long-distance bus out of New York City. The photos were released hours after a gray backpack was found in Central Park, matching the description of one carried by the gunman. In it, a jacket and Monopoly money were found, according to people familiar. And a World Health Organization rapid response team is headed to the Democratic Republic of Congo after over 400 cases of a mysterious flu-like illness were reported. They're calling it Disease X. The outbreak is centered in a remote region in the southwest Congo and began in late October. So far, 31 deaths have been recorded. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Coming up next, Trump pledging to keep Powell.
Will you try to replace Jerome Powell?
No, I don't think so. I don't see it. But I think if I told him to, he would. But if I asked him to, he probably wouldn't.
Basically, if I asked him, but I won't. If I told him, definitely. That's all coming up next. This is Bloomberg Surveillance. Heading into the third to last trading week, full trading week, sort of 2024. Can you tell that I'm counting down? We all are counting down, and the question is just how much does that market can melt up. Today, it's range-bound. S&P futures lower by about 0.1%. A real question on the bond market ahead of CPI. Under surveillance this morning, Trump pledging to keep Powell.
Will you try to replace Jerome Powell?
No, I don't think so. I don't see it. But I think if I told him to, he would. But if I asked him to, he probably wouldn't. But if I told him to, he would.
You don't have plans to do that right now?
No, I don't.
Here's the latest. President-elect Donald Trump telling NBC's Meet the Press with Christian Welker, saying that he has no plans to replace Fed Chair Jay Powell when he returns to the White House. The comments come just a few months after Trump told us here at Bloomberg that as president, he should have a say in monetary policy and the setting of interest rates. Neela Richardson of ADP joining us now. Obviously, he wants rates to be lower. He is a developer after all, and that will juice housing markets and a whole host of the economy. A key question of how tied the hands are of the Fed to the fact that inflation might be the surprise card here heading into the end of 2024.
Right. So when you look at last week's jobs report, you get a bit of a riddle for 2025. You get very strong job growth, uptick in the unemployment rate, and importantly for the Fed, really robust wage growth. Where does that lead to? Sticky inflation. So the riddle is an H for hiring or an H for hiking. We don't know in 2025, but the wage growth is putting pressure on inflation, and that's something the Fed has to keep in the rearview mirror as they're trying to support the labor market.
Pause. You've said recently that it seems like this jobs market is on a knife's edge and could go one way or another. Are you saying that we're at that tipping point where we could see whether the solidity of the labor market is actually contributing to an increasing likelihood of stickiness and even a rate hike?
Yeah, we're in the stasis period, this really quiet period in the labor market where there's very low layoffs and now pretty, average hiring. If you take the last 3 months of the BLS data, you get something a little bit less than 140,000 jobs created. every month on average. So that's solid. But I don't think we stay in this equilibrium. I think there is a tipping point that is coming, and I'm not quite sure whether it's a tipping point lower or a tipping point higher, so I'm watching wages. And what wage growth suggests, both in the BLS data and in the ADP payroll data, it suggests that wages are still robust, they're still growing. That suggests there's still a bit of tightness in the labor market, and I think that's tied to longer-term trends, not something that the Fed can fix right away.
Is there a possibility that when that equilibrium shifts, if it does shift towards sticky inflation, that it's not just sticky, but wage growth also translates into reacceleration of inflation?
And that's the problem for the Fed. It depends on what they do. Right now, it seems like they're on track for a cut in December. That could be followed by a pause early next year. We're all hoping that it's not a hike, because that would imply an acceleration of inflation much higher than the Fed's projections right now. But given how robust wage growth is, remember before the pandemic, that 10 years of expansion, wage growth was between 2 and 3%. We're now at 4%. So there's no consistency of a 4% average hourly wage growth with 2% target inflation.
Is there a risk, though, that if the Fed is cutting in December and they continue with some cuts, at least in the first half of 2025, that they allow that reacceleration to happen, that they create the environment where the animal spirits can continue, hiring can continue with the hopium of what a Donald Trump presidency means, and that's what creates it?
Well, decades of Fed policy teach us one thing, that monetary policy is risky business. I mean, usually that's how the economy falls into a recession. The Fed hikes rates to contain inflation, and that tips the economy into recession. That did not happen this time. Interest rates went higher, and the Fed and the economy kept growing. So we really don't know, in the context of the current economic environment, exactly what's going to happen to the economy. When you look at the consumer, when you look at the labor market, it's still very solid and resilient. So that's, I guess, the hope for the Fed. They still have some wiggle room.
Following the jobs number, we saw these bets for December cut go up. Was that too premature, given the fact that we don't have CPI yet?
Yeah, I think the Fed is waiting for CPI. We're seeing a 3.3% core CPI right now. We're seeing a month over month that we're not going down to like a 0.2 or a 0.1% monthly range. That is a nervous period for the Fed, because if we keep going up month after month at 0.3%, that is not going to drag us back down to that 2%. So it's not just wages. Here now, it's shelter costs and housing that's driving up inflation.
Well, we heard from Mickey Bowman on Friday following that report, and she says we have so much growth right now, it's hard to think that the level of the interest rates is restrictive at this point. Are we restrictive?
That's a question for the FOMC. And we're starting to see that there's a lot more disagreement on that FOMC than there was previously. Look, when inflation was unspeakably high, it was easy to get everyone on agreement, and it was easy to see the path. As we get closer and closer to that 2% target, I think you're going to see the FOMC opinions start to diverge on where is that neutral rate and how to get there. And that's what you're going to see in these public comments now.
Neela Richardson of ADP, thank you so much. And we'll see you for a full hour tomorrow. I will just note this. Morgan Stanley put this out that I thought was fascinating. And I'd love your thoughts on this, Danny. That aggregate payroll incomes provide strong support for consumption. They are rising at 5.5% annual rate versus the third quarter, stronger than the 4.5% pace in third quarter, or 4.9%. Basically, we're looking at a reacceleration of how much people are earning and the hours that they're actually working.
And the big risk has been a restoking of demand. And that also plays into 2025 with the kind of policy that we might get. Are we going to get policy that includes tax cuts, things that, again, allow people to have more of a disposable income and spend more? If you're already seeing some of that happen in the pay roll numbers, if you're already seeing that in some of the wage growth, what does 2025 look like then?
One thing we did hear from Trump over the weekend with this NBC News sit-down was that he does want to focus on, in the first 100 days, immigration first. He said, then we're going to come to taxes. So kind of what we heard out of the Senate as well. It's going to be immigration and then taxes. The big question is, when do tariffs come?
And what does immigration do to the workforce at a time where there potentially is upward pressure on inflation? Now, coming up next, Chris Harvey of Wells Fargo, Henrietta Trey's of Veda Partners, Norman Rule of CSIS, and Kevin Rosenbaum of Cambridge Associates. This is Bloomberg.
profitability of U.S. companies is unlike anything else that's available in the global equity market.
I'm not necessarily saying we're sitting at like 2000 dot-com bubble type overvaluation, but we look a little bit over our skis.
There will be a lot of unpredictability in this next cycle.
There will be increased volatility. I think that's what we need to be mindful of.
The United States still is going to outperform both in terms of economic growth and equity markets, yes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Just 3 more weeks of the year. And what we see right now is just a sense of how high you can raise your forecast for next year, because clearly it wasn't ever high enough heading into 2024. A real question here after 3 straight weeks of gains, and what you can see in markets right now is this sense that maybe we're just range bound waiting for some sort of catalyst to see whether we can breathe a sigh of relief or not. A question before we get to sort of the angst of the morning is just how many potential upgrades are we going to see heading into the close of 2024?
It's really interesting you mentioned where we were at this point last week, because I was looking back on it. We were somewhere around 4,300 in terms of the year-end average of analyst expectations. Obviously, we are way above that at this point. But at the time, that had implied that we would move up less than 1%. I wonder how much of this is also just overcorrection to say, hey, we missed that rally in 2024, and we're not going to do it again.
Meanwhile, what you could see in oil prices is just a creeping sense of anxiety that maybe something could disrupt this happy talk and the nirvana of the soft landing that everyone seems to be banking on. And that is the idea of geopolitical risk, namely that Syria saw an upheaval after 50 years of rule from the Bashar Assad regime, that suddenly there is a vacuum of power in one of the proxy war grounds for Iran, for Russia, for others.
Absolutely. I think the bigger questions for the region and for the world, and for investors that continue to say, we're bullish no matter what, is what happens in terms of Iran and Russia in Syria. For Iran and Russia, this is strategically imperative to make sure that they have a stronghold in that country, whether or not that's access to the Mediterranean Sea or it's for logistic purposes for Iran in supplying their proxies. This morning, Bank of America put out their credit investor survey. Their biggest concern for 2025, maybe some of the tail risk to all this bullishness, is geopolitics. 30% say that's their number one concern next year.
And this is the reason why you're seeing a lot of attention on it. Not a lot of movement. People are sort of keeping an eye. And at what point, and you asked this earlier, Danny, at what point does this just solidify the narrative of Tina? There is no alternative to the United States because the rest of the world is falling into an increasing question around even leadership, let alone economic resilience.
I mean, that's why you keep seeing this demand for U.S. assets, because yes, what else is there? What else is there when it's not just the Middle East that's a hotbed of conflict right now, when it is France, when it is Germany, when it is South Korea, when it's Romania as well over the weekend. But at what point do you say this isn't a complete upheaval of global order, that the neoliberalism that allowed the rallies of the past decades is coming to an end, and we need to rethink developed market assets?
It all sounds great. It all sounds really good. Jeff, you would come out and say, watch the auctions. Maybe I would say that, but I would just channel his thoughts on this question of what's coming up this week. Because we do get CPI on Wednesday, the key benchmark of the week, at a time where the focus is not really on how weak is the labor market, resilience there as we saw on Friday. But the real question is, how sticky is inflation? Does it push the Fed to potentially stop cutting rates, even hike rates next year, at a time when there's a real question about whether you can have your cake and eat it too in the United States of America? Coming up, Chris Harvey of Wells Fargo as stocks come off their 3rd straight winning week. Henrietta Trey's of Veda Partners as President-elect Trump doubles down on tariffs from day one. And Kevin Rosenbaum of Cambridge Associates on market leadership heading into the new year. We begin with this hour with stocks range-bound. November payrolls boosting bets that the Fed will indeed cut rates next week. The S&P 500 notching its 57th record close this year. Chris Harvey of Wells Fargo looking ahead to next year, saying this: stocks go higher, but so does risk. On balance, we expect the Trump administration to usher in a macro environment that is increasingly favorable for stocks at a time when the Fed will be slowly reducing rates. In short, a backdrop where equities continue to rally. Our year-end 2025 S&P price target, 7007. Bond, James Bond, joining us now, otherwise known as Chris. Chris, cute, very cute. So you start talking about how there are these worries, and then you go on to give this pretty bold projection. Why do you sort of cast aside your worries?
We don't cast aside our worries. There is a wall of worry. It's tariffs, it's inflation, growth isn't strong enough, geopolitical, so on and so forth. We just think you're going to scale that wall of worry. And what we're talking about is risk is going higher. And that's true. But when risk goes higher, equity markets also go higher. So I think one of the things that we've said, and the title of our outlook is Good Year, Bad Vintage. Right, we're going to look back. Thank you.
This morning. Carry on.
Equities will go up, but when we look back at 25 from the perch at 26 or 27, we'll realize that's when people went too far out on the risk curve. That's when they went too far down the capital structure. That's when they put too much leverage on. And so we think that this is a year where risk does take off, so do equities, but by the end of the year, you really got to think about repositioning that portfolio. So equities up, yes, but risk too.
So on your yacht with James Bond, with your surging stock market, you also have a bad vintage of wine that's preparing for something down the pike. Before we get into leadership and some of the internals of that, a real question of how much a check the bond market is on some of this euphoria at a time where we were just talking to Neela Richardson about the potential for stickier inflation driven by this robust labor market.
So what we were worried about and what the market is worried about is inflation. And what we were looking at was break-evens. Break-evens were between 2.25% to 2.5%. That's at the high end of the 20-year range, right? So you're already pricing in a pretty aggressive inflation expectation. We were already, I thought, toward the high end of the range at 450. So we can get to 475. I just don't think you can get there to 5% really on fundamentals. Because if you look at real rates, you look at break-evens, they don't support a 5% range. We get there, yeah. Is that a problem for equities? No doubt. But it's hard to see that from a fundamental point of view, especially when the Fed is still in an easing cycle.
I'm interested in the timeline for all of this because for you say, okay, 2026 is that year where some of, you have to uncork the bottle of wine, if I can really paint that metaphor. Andrew Sheets of Morgan Stanley, to use another metaphor, called this a dessert-first market, that we have all the easy stuff. Yeah. But for his timeline, that ends second half of 2025. Yeah. What for you is the thing that says this can continue on for another year?
Oh, gosh. Well, what can continue on for another year? Fed continues to ease. We look at something like 04 to 06, where they lowered 25 basis points at a clip, and they continue to do it, not at every meeting, but continuing into 26. We get an M&A cycle that begins to really heat up. Fundamentals still stay strong. And things that were overblown with regard to the tariffs really are just overblown. And so you have a situation where the economy is good. Inflation is coming down. Inflation is moderate. The Fed is easing, and we have pretty strong M&A market. I think you can see equities continue to run in that environment. And maybe I'm wrong that systemic risk or risk really takes another 18 months to build.
I'm curious, you didn't say in there that one of the things that helps us along is technology and the promise of AI. We've seen some bears thrown. The Tao Robini was on this show, sounding remarkably bullish in contrast for how Noriel usually sounds. David Rosenberg has also kind of cast aside his concerns, saying that it's all about technology and valuations. We need to look at them differently now because of what AI is going to bring in the next decade. How much truth is there to that for you?
Listen, AI is a generational technology. We're just building the foundation at this point in time. We're beginning to see some of the software companies are beginning to see some commercialization, but we're just in the infancy. Is that going to reduce productivity? Yes, increase productivity. The answer is yes. Is this any different than the early 2000s? I think yes, because valuations are different, but that was a generational technology that took years and decades to really play out. And I think this is true for AI as well.
What gives you the confidence that the tariff narrative is overblown?
Right.
Yesterday we heard from President-elect Trump, who said he's a big believer, once again, of tariffs. He says he's going to enact them. He says he wants to make sure there's fair, fast, level playing field.
Right. So, Anne-Marie, let's look at it this way. If you wanted to raise revenue, right, are tariffs the right way? Because the next administration can get rid of that tariff. Right? If you really wanted to raise revenue, what you'd be saying is, hey, we're going to put in a seller's fee. The U.S. is the biggest market in the world, right? It's a privilege. If you want to sell your goods here, there's a seller's fee. It's like Amazon, eBay, Airbnb, even the stock exchanges, right? You have Congress to do that. So that's the first thing. It doesn't make sense that this is really a long-term solution. The second thing is, when you look at what happened, right, he's trying to create a sense of urgency, and he is creating a sense of urgency. He will do it, right? But what's happening now is other people know he will do it. Their economies are weaker, and they're coming to the table. So the reaction function is, hey, we're willing to negotiate, and if people are willing to negotiate, he's willing to negotiate with him. I don't think the Chinese will do it. Right? I think the Chinese, and we will put tariffs on China, and it'll be a tit for a tat. But with our allies, I think they'll be much more they'll work with us going forward.
So for you, it's a negotiating tactic.
Yeah, for us, it's a negotiation with our partners, with our allies. With China, I think it's just a tit for a tat.
Well, we just got a headline from China saying that they're probing Nvidia on suspicion of anti-monopoly law breaches. We do see Nvidia shares lower. Danny made the point earlier, and I think it's an astute one, that potentially if this is a president who is going to really care about the stock market, that other countries are going to play with that and try to announce different measures that send certain large stocks down. How much do you want to be susceptible to this? How much do you view this as a negotiating tool on the other side versus something more concrete?
Yeah, if you're on the other side and your economy is weaker, you're going to look for things to do. You're going to look for a pain point in the United States, and that is a pain point. But at the end of the day, it comes back to fundamentals, and if the fundamentals are still strong, yes, we'll cause some volatility, but the stocks in the stock market will continue to move higher. Furthermore, I really do think, right, if we look with our partners, they will work with us. It's in everyone's best interest to work together. And what Trump is really doing is, and you have to think about this, he's like, I'll give you one more.
Oh, I can't wait. It's going to be a doozy. I can see it in your eye. Let's go.
He's like he's a James Brown of politicians. Everything is on the one, right? I have to get it done now. I have to do it because I don't know what's going to happen with midterms and elections. Sorry about that.
Carry on.
And so as a result, you know, he's willing to negotiate. He wants to get things done. And as long as people will work with him, he's willing to work with them. And there's a lot of leverage on that other side to get things done.
Lisa mentioned Nvidia, but you're not suggesting investors pile into some of these massive big tech names. You have 40% banks, 40% communications, and 20% consumer staples. Why that breakdown?
Right. The breakdown is because on the regulation side, we've had 15 years of upward pressure, upward regulatory pressure. That's not dissipated. That's not repriced in 15 weeks. Right? And furthermore, we're going to have more multiple expansion. We're going to have EPS growth. And we haven't even named a new head new head of the FTC. Right? That's going to provide a new dynamic. So that's banks, that's financials. Right? Communication, that's a quintessential GARP space. Growth at the right price. That's a sector we've been riding for the last 2 years, and we continue to believe that the fundamentals are good. Staples are unloved and underappreciated. That's our hedge for the portfolio, right? And their fundamentals are beginning to change as we look at some of the price volume dynamics. So really, 80% of it is cyclicals, GARP, 20% of it is hedge. We have a little bit of everything in there, and we think that's going to allow us to participate on the upside, but really protect on the downside, because there will be downside this year.
Chris Harvey, never change. Chris Harvey of Wells Fargo, thank you so much with your punniness to start a Monday morning. For more on the China issues as well as on other news this morning, here is your Bloomberg Brief with Yahira Hackis. Yahira.
Hi, Lisa. Nvidia shares are falling 1.7% in the pre-market. This after China's Central Television reported the country is probing the chip maker on suspicion it broke anti-monopoly laws. Nvidia's position as the leading provider of AI chips has put it in the crosshairs of the U.S.-China battle for supremacy in the tech sector. Washington has barred the company from selling its most advanced semiconductors to Chinese companies, undermining their ability to develop AI services, a move that has drawn sharp rebukes from Beijing, including today. Shares of Interpublic Group are surging in the pre-market, up more than 15%. The Wall Street Journal is reporting Omnicom Group is in advanced talks to buy Interpublic in a deal that would create the world's largest advertising firm. The report said that an all-stock deal could be announced as soon as this week. And President-elect Donald Trump's daughter-in-law, Lara Trump, will formally step down as co-chair of the RNC. Writing in a post on X, she said, "The job I came to do is now complete, and I intend to formally step down from the RNC at our next meeting." She told the Associated Press she would seriously consider filling Florida Senator Mark Rubio's remaining term if that option becomes available, since he was tapped to be President-elect Donald Trump's next Secretary of State. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. And the chessboard continues to load up with pieces. Up next, doubling down on tariffs.
I'm a big believer in tariffs. I think tariffs are the most beautiful word. I think they're beautiful. It's going to make us rich.
That's coming up next. This is Bloomberg Surveillance. Starting off the first day of the trading week with a little bit of softness, although really emphasis on little after 3 straight weeks of gains, which you can see is not even 0.1% down on the S&P 500 across the board, marginally higher in the yield space. Crude taking some note given the fact that we are seeing the disruption in the Middle East. Crude prices up 1.3% traded on the NYMEX. Meanwhile, if it hadn't been for Syria, probably everyone would still be talking about the NBC interview over the weekend with Donald Trump, the first that he's given since being elected president, under surveillance this morning, doubling down on tariffs.
I can't guarantee anything. I can't guarantee tomorrow. But I can say that if you look at just pre-COVID, we had the greatest economy in the history of our country. And I had a lot of tariffs on a lot of different countries, but in particular China. We took in hundreds of billions of dollars, and we had no inflation. I'm a big believer in tariffs. I think tariffs are the most beautiful word. I think they're beautiful. It's going to make us rich.
Here's the latest. President-elect Trump telling NBC's Meet the Press with Kristen Welker he's adamant about implementing tariffs on day one of his administration, but saying he can't guarantee they won't increase prices for American families. He can't guarantee anything because he can't guarantee tomorrow. Henrietta Trey's Aveda Partners expecting Trump to impose tariffs via executive order in the first half of 2025. Henrietta joins us now. Henrietta, what do you make of the fact that right now in markets, people are taking it seriously, but not literally, and viewing it mostly as a negotiating tool, particularly when it comes to the U.S. trading partners of Mexico and Canada?
Yeah, I mean, I think the tariffs should be taken extremely seriously and very literally, as evidenced by the fact that they've been on since he took office the first time around. So to think that these tariffs are somehow not serious underappreciates the fiscal reality, which is that if he wants to pay for the extension of the tax cuts, he needs the revenue. If he wants to invest further in domestic manufacturing, he needs the revenue. It is the single largest pay for that the president touts on the campaign trail, as does his cabinet secretaries, from Bessent on down to Hassett and others. So the revenue has to come, which means the tariffs have to come. So I would take it very seriously. Also, they're obviously on and have been on for 7 years. With China, obviously, we have now a response function coming from China suggesting that they take it very seriously. So I like to acknowledge what the rest of the global leaders are thinking and responding to. There's a big difference between Macron inviting Trump to come see the opening of Notre Dame versus President Xi reigniting the unreliable entities list, putting Nvidia on today. Their reality is that they do not do as much trade with the United States as we do with them. So they can never proportionally or directly respond with tariffs the same way that we can. And as such, they have to move into things like unreliable entity lists and putting a lot of bureaucratic red tape on American companies.
Henrietta, we also heard the president say that he wants a level but fast and fair trading field when it comes to why he would use tariffs. So do you see this as just to re-level trade or specifically for pay-fors?
I think a lot of this is pay-fors, because level trade is something that we can talk about with preferred status. We can talk about with GSP, things that he's changed from China to India, putting Section 232 tariffs on the EU and other allies. I think the revenue component is the silver bullet that he thinks solves all the problems associated with, for example, the $4.6 trillion cost of extending the tax cuts. And that includes, basic congressional function and requirements politically for raising the SALT cap, not having the votes for full IRA repeal, et cetera. So I think the revenue component is a really big part of this. And let's be mindful that his incoming USTR also supports subsidization in domestic industries, much in the way that Biden did as well. So not only do we need revenue to extend the tax cuts, but we also need to subsidize these domestic industries to either offset the cost of the tariffs or to get more domestic sort of boosting in those sectors.
We also have the incoming USTR ambassador that says that basically China's permanent normal trade relations should be revoked, and they want to decouple. Do you see a decoupling from China under a Trump administration?
I think the export control restrictions are going to continue to get more robust. Jameson Greer also advocates a special basket of sanctions just on China, whether that's on corporations or on individuals, certain activities, almost like a extra Section 301 investigation with sanctions designed to go after very specific activities. So that's something that we'll be watching from Jameson Greer next year as well.
Henrietta, also in that NBC interview yesterday, Trump said that he won for two reasons. One was the border. The second one, which he really emphasized, was groceries, i.e. inflation, that prices were too high. How sensitive might a President Trump be to if tariffs lead to corporations, especially grocery stores, saying we're going to need to raise prices, or prices actually rising themselves? Would he reverse course in that scenario, do you think?
This is such an excellent question. So the lingering question is whether the next president puts on the list 4B tariffs. These are items that you buy in the grocery store, powdered milk products, anything with an alcohol extract, scented candles, everything we're buying for the holidays. These are extraordinarily regressive, very consumer facing, about $180 billion worth of goods. And most notably, they have never been tariffed before. I was with trade administration folks for the Biden administration just a few weeks ago, and they said to me point blank, look, if 4B was easy, we would have done it. So when you're talking about challenging China and raising revenue and increasing revenue, that's the other thing that's, I think, lost in this conversation is that if you're trying to generate revenue from tariffs and you don't believe they're inflationary, you need to keep raising the tariff rates to continue offsetting, whatever manufacturing moves or whatever GDP negativity comes through as a result of sustained tariffs. These list 4B tariffs, I think, are very real and are very disconcerting. Right now, they're on at 0% rates. They could start at 7.5. They could start at 15. But these are highly regressive. These are groceries. These are the things that you're buying, not just at Walmart and Target, but at Dollar General, at the grocery store, just basic, fundamental, everyday items. And that's the remaining basket of items that he has not yet tariffed.
Just to be clear, Henrietta, can Trump accomplish what he wants in terms of revenue raising without those tariffs?
No, you are not going to be able to get $2 trillion, which is the number that we hear from various cabinet officials and Trump on the campaign trail from tariffs, unless you escalate materially. It's about $72 billion per year that we bring in on all tariffs. So if you want to hike that, you need to go bigger and harder.
Henrietta, Michael Zezas of Morgan Stanley over the weekend had a note that kind of encapsulated some of the desire to have big headlines in the first 100 days, but to Danny's point, to avoid real increases in consumer prices. He said, we call our base case for the U.S. policy path over the next 2 years fast announcement, slow implementation. In short, we expect the Trump administration to achieve meaningful changes in these 4 policy channels, but believe practical and political constraints will shape their implementation. Do you agree with that?
I don't think so. I think there's so many different ways to impose tariffs that we shouldn't be sitting back on our laurels expecting this to take a while. For example, IEEPA tariffs on the fentanyl issue. That's a 10% tariff he's threatened recently. The same on Canada and Mexico. Those can be effectuated day one, and it takes 12 hours for Customs and Border Patrol to start collecting different tariff rates. On the Section 301 front, it's possible that President-elect Trump adheres to the Phase 1 trade agreement written by his former USTR, Ambassador Lighthizer. That would put tariffs into place around April, May, June. What my concern is in the aftermath of Ambassador Lighthizer not joining the second Trump administration is that this guy, who we know believes in a strong enforcement mechanism and indeed believes that a trade agreement is only as good as an enforcement mechanism, would want to stress test that and go by the book, say, hey, China, you did not adhere to our agriculture purchases. We're going to pull out of the Phase 1 trade agreement. You are in violation. And then that sets up, 10 days here, 45 days there, where we get tariff functionality and hikes in sort of June. Now, Lighthizer is not coming to the administration. We know that Jamieson Greer has a view that he wants to break the trade agreement even further. I don't know that they would adhere to the enforcement mechanism written out painstakingly in the Phase 1 trade agreement. So I think that that creates a pathway to these tariffs being increased immediately. And then be mindful that Congress is not going to vote on these tariffs, which means that in order to generate revenue and reflect to Republican lawmakers that revenue is coming in, the revenue needs to start coming in, which means the tariffs have to go on.
Henrietta Trace of Aveda Partners, thank you so much. Coming up, Norman Rule of CSIS as the U.S. strikes ISIS targets in Syria. You're watching Bloomberg Surveillance. hours away from the cash open, what we can look at right now is this feeling in markets. What's next? Markets are basically range bound, although there's an underperformance right now from the NASDAQ 100 after China announced a possible probe into Nvidia for anti-monopolistic policies. A real question here. Shares of Nvidia down less than 2% now, clawing back some of the earlier losses. Right now, here is your morning movers with Manus Cranny. Good morning, Manus.
Good morning. Good to see you, Lisa. Kick it off with Interpublic. Omnicom is in talks to do an all-stock deal, creating a beast, an advertising beast on a global scale. It would jump across the value of WPP. So just the size of this, the heft of this deal would be a $20 billion beast if it goes through. It values it Interpublic $13 to $14 billion. Think of the bid and the offer in this. The bid side is you've got cost efficiencies and scale, especially when it comes to technology delivery within the advertising world. The other side of that trade is, of course, you lose clients, you lose staff who become disaffected with a long process of integration and potentially a duplication on the client side. But for now, 14.56% higher. Palantir teams up with Anduril. Now, this is the weapons maker. They're going to stick sensors on the vehicles, on the robots, and it's about molding that data together. Smart war, smart defense, whatever way you want to call it. But it's about taking Palantir and Anduril and putting it together, creating an AI overlay on the reality of defense. Palantir is worth $173 billion. That is more than Lockheed Martin. Peter Thiel is obviously smiling this morning. He backs both Palantir and Anduril on this. Morgan Stanley, they've got a big note out on the banks. I just picked off one, Lisa, State Street. They've upgraded BNY, State Street, along with Northern Trust. They talk about the end of QT being something which is going to reinvigorate the deposit gathering process for the banks. State Street, the example I've given you, they're raising the price target there to $139 from $102, but they talk about a higher capital markets activity, that is deregulation, regulatory stabilization, and higher deposits. So that's state of play on the banks. Lisa, good morning.
Good morning, Menace, and thank you very much for that, as always. Under surveillance this morning, bulls on parade. John Stoltzfus of Oppenheimer expecting the S&P 500 to reach 7,100 by year-end 2025. His call now the most bullish on the street. For now, let's wait a couple minutes. Stoltzfus saying, quote, the current bull market likely has legs strong enough to climb the proverbial wall of worry into and through 2025. Danny, basically, try to find a bear right now. They seem to be extinct.
In the words of Sabrina Subramanian, yes, indeed, the bears have gone extinct. I think it's worth, though, looking back and just noting how wrong we have been over the past 4 years when it comes to year-end calls. Jim Reed of Deutsche Bank laid this out. 2020 upended by COVID, 2021 upended by inflation, 22 by the aggressive height cycle, and 23 by everyone saying we're going to get a recession, and we didn't get one. The risk this time is we're all crowding around the high end. Are we going to be wrong yet again?
Well, and that's the sort of interesting point, actually, about John Stoltzfus, because he was the biggest bull on the street this year. He had lifted his 2024 target to 6,200 in November, the last month. We're getting close to 6,100. I mean, it just sort of raises this question of, what have people gotten wrong with their lack of enthusiasm heading into this year?
Well, something I love that he says is we're not suggesting paradise on earth. I mean, you look at actually what is going on in the world and the geopolitical scares and the tail risks you're hearing banks talk about for next year. That's where it is. So not expecting paradise on earth or a Goldilocks world. So there are going to be challenges, but he says there's this genuine potential for AI to provide greater efficiencies in key areas that are challenging progress today. So basically, this AI run, people like John Stoltzfus, has more to run.
Yeah, and other people are really filing into that thesis as well, including BlackRock. Meanwhile, President-elect Trump saying he has no plans to replace Fed Chair Jay Powell, saying, quote, I don't see it. Trump has previously said he thinks he should have a say in monetary policy and the setting of interest rates, calling Powell's role in the easiest in Washington. Powell's term expires in May 2026, so get out some of the forecast books to try to figure out who could take his place. But AMH, to me, what I find interesting is the point you are making. Inflation will call his hand. He lost the election, or I should say, Biden sensibly lost the election in part because of inflation. How much is this a very delicate moment that he doesn't really want to disrupt?
I know. I think we talk about all the time that the checks on Donald Trump has always been the stock market. Well, it also might be the fact that if inflation is coming up, and he talked about in his NBC interview, it's the idea that groceries was the reason why he won, because basic necessities were going up. So that could potentially be one of these checks on all of his policy proposals of next year. And of course, To your point earlier, he's a real estate developer. He wants to see rates going down. What was interesting, though, is he said he doesn't see that happening. But if I told him, he would. If I asked him, he wouldn't. I don't know if there's a difference.
Right. Well, I mean, he's kind of making clear, look, I could get rid of him. I think he'd listen to me. He'd listen to me if I wanted him to go. And I think inflation might be the thing that not only forces his hand to rethink policies, but rethinks the Fed chair. Angie Brenner of Nat Alliance was one of the first reactions I saw to this interview that said, yeah, he doesn't want to let him go because he wants to cut rates.
He wants a dove.
Exactly. What happens if that changes and all of a sudden you get a stronger dollar, which Trump doesn't want because they're hiking rates? And again, Trump wants rates to come down. Is that when you get a rethink of who's running the Fed?
And what could cause some sort of potential rethink on the Fed is potentially the commodity market. That's what Alicia Levine last week was saying of BNY, that essentially the oil market could hold the keys to whether or not we really do get this soft landing. Oil, meanwhile, gaining as the market weighs fallout from the Syrian government's collapse. The fall of Bashar al-Assad's regime creating a power vacuum, with multiple groups now vying for control. Crude has been confined to a tight range since October, and you don't want to make too much of this particular move. A glut is expected next year with little room for a significant OPEC plus output boost. And you made this point, AMH, that basically this isn't that big of a move considering that we just saw a 50-year regime collapse in a matter of 11 days.
And that goes back to the market fundamentals right now in the oil price. The fact that OPEC is not able to put more barrels into the market that they were supposed to just because there is this glut. You cannot be overestimating the fundamentals right now and the weak demand coming out of China, even though they are out talking about looser monetary policy and fiscal spending. Saudi Aramco over the weekend, I think more important for the oil market today than what's going on in Syria, cut its oil prices to Asia. This is the fundamentals at play here. And 2025, everyone is talking about there's going to be a bigger glut.
That's the dynamics in the oil market. With respect to the Middle East, the U.S. is currently striking dozens of Islamic State targets in Syria after President Biden warned Bashar al-Assad's fall could clear the way for a resurgence in extremism. Joining us now is Norman Rule, former senior U.S. intelligence official who always provides us with fantastic insights into the Middle East. Norman, what's your first takeaway from how destabilized this region is and what you want to be watching to understand what could come next?
Good morning. The collapse of the Assad government is an inflection point for the region. It does offer areas of risk, and the United States and Israel are doing everything they can to minimize that risk. Israel has undertaken multiple strikes against missile, chemical weapons facilities in Syria in a manner that's been unprecedented since the 1973 war. Israel has also moved some forces into a neutral zone to prevent anyone from moving into that territory to threaten Israel. The United States has attacked dozens of ISIS sites in eastern Syria because ISIS has conducted a resurgence over the last year that has been worrying. And the United States wants to make sure that with the collapse of the Syrian army, that ISIS does not take advantage of this and expand further. I'm not sure that at this point there's a risk of expansion of this instability beyond that territory. There are about 6 different groups who maintain present control of different areas of Syria, but that was true a couple of weeks ago as well. Now it comes down to whether the group in control of Damascus will live up to its word and create a unity government, and that would be good for the entire region.
And Norm, you raised this point. Is the question really instability in Syria, which really doesn't have a very large population and has been in disarray for a long time, or does it raise a question about Iran at a time where their power has been dramatically diminished across the board in the region? And it seems like there is a tipping point moment for them, especially with a new administration coming in at the U.S.
Absolutely. The arrival of the Trump administration, the collapse of Iran's ring of fire around Israel, the multiple instances of Israel being able to conduct apparently covert and overt military activity within Iran. Iran's regime is weak. It's also going through an era of leadership transition. Its economy is poor. It has a restive population. Iran needs stability. The question, therefore, becomes how it handles its nuclear program in coming weeks.
So, Norm, at this moment, is Iran closer to getting a nuclear weapon or less so?
Iran, according to the International Atomic Energy Agency, has never been closer to its ability to produce sufficient fissile material for a nuclear weapon should it decide to build so. It has increased the number of advanced centrifuges in facilities that look as if they were designed for a nuclear program, and the amount of highly enriched uranium is growing in Iran. At the same time, Iran is incredibly vulnerable. Iran knows that Israel could strike most of these sites and destroy them at will. So for Iran to undertake that activity, it's got to think that it's going to get away with it and will be able to complete its activity before it can be discovered.
Norm, can we talk about the breakdown of Russia and Iran in Syria? The fact that you have President Biden coming out and saying they broke down because they were dealing with other crises. Iran was dealing with their proxies fighting Israel, whether that's Hamas or Lebanese Hezbollah, and Russia, of course, with Putin's offensive in Ukraine. Is that accurate?
Well, perhaps some of that is true, but we've also got a number of other issues underway. Israel has eradicated much of Hezbollah and Iran's Syria-experienced leadership over the past year, and they took to their graves their capacity to build cohesive operations with multinational, multicultural proxy forces in Syria. So that introduced a significant amount of lack of efficiency that Iran never overcame. The Russians have maintained forces in Syria and aircraft, naval assets, and ground forces. But I think what we've saw in Aleppo is a failure of intelligence, a failure of planning, a failure of coordination, and then events moved so quickly that these forces could not put together a credible opposition to the Syrian oppositionists moving south. I mean, we're really seeing weakness in those forces for a variety of reasons.
So the net effect of that for Russia is effectively losing their anchor in the Middle East, Norman, at a time where you also have another former Soviet state, Georgia, pushing for increased involvement in the European Union. Marko Papic of BCA says that it means the jig is up for Russia when it comes to Ukraine, that Putin has been playing checkers and not chess. Do you think there's any validity to this, that this also impacts what Russia is doing in Ukraine currently?
Well, it certainly will impact Russia's capacity in the Middle East. The Russians are going to try to reach out to the opposition in control of Damascus to see if they can retain their forces. Russia's naval bases in Syria allow it to maintain a naval presence in the Mediterranean. Without those bases, it's going to have to try to strike a deal with Egypt or perhaps Algeria. Its air base in Syria allows it to support operations in Libya and Africa. The ripples from this, the collapse of the Assad government have yet to play out, and Russia will pay a severe price if it loses its presence in Syria. And of course, this will have an political impact in Russia and be seen as a result of its wasted energies in Ukraine.
So as you see these world players, their current presence in Syria be upset, Iran, Russia, Norman, what is America's role in all of this? They still have troops in Syria. We learned that the U.S. had done targeted strikes against bases of ISIS. How does that evolve in the coming months, in the coming year?
The United States should protect our 900 plus forces in Syria. The United States should maintain its activities and an international activity against Daesh. We want to prevent that from expanding. The United States should support Israel to ensure that its borders are secure. But at this point, I think the best thing to do is to work with the region. They know their problems better than we do. They're going to have to support Syria in the long term and work with moderate Arab states to assist them as they develop some sort of coalition in Syria to bring together a national government.
Norm, last night we heard from CEMCON about strikes against ISIS leaders, operatives, and camps. Why last night, and why not do that 2 weeks ago?
Good question as to why not 2 weeks ago, but certainly the imperative in the wake of the collapse of the Assad government and the collapse of the Assad army made ensuring that ISIS does not have the opportunity to expand further was significantly greater. It's a wise move. It's a smart move. But again, it demonstrates that 72 sites had to be hit in eastern Syria. This tells you something about the organization of ISIS and how CENTCOM perceives that threat. And again, there are thousands of ISIS prisoners that are still being held by the Kurds. Someone has got to figure out what to do with this population. If they're ever released, that would provide a massive injection of personnel to ISIS, which would enable it to expand and destabilize the region and perhaps Europe and elsewhere.
Norm, just real quick here, are you more or less concerned about the state of the Middle East right now than you were before the weekend?
I'm optimistic that there are more opportunities for regional players to improve the Middle East with Iran's, the collapse of Iran's axis of resistance. At the same time, this requires an international effort to support those players. We need a strong team in the United States to provide assistance and guidance without pulling ourselves into this mess. And of course, the Houthis remain relatively untouched and powerful. Indeed, they fired a missile reportedly against Israel only last night.
Norman Rule, thank you as always for your insights. We always really appreciate it. Right now, let's get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakez. Yahaira.
Hi, Lisa. President-elect Donald Trump in an interview said he had an exchange with Chinese leader Xi Jinping in the recent days. This is the first clear indication of direct contact between the two men since the U.S. election. Appearing on NBC's Meet the Press with Kristen Welker, Trump said they talked as recently as last week without specifying exactly when or what was discussed.
I had an agreement with President Xi, who I got along with very well. We've had communication as recently as this week. And I had communication with him where they were going to give the death penalty to anybody sending drugs into the United States.
Trump and Xi last met in person in June 2019 on the sidelines of the G20 summit in Japan. Meanwhile, inflows for U.S. Bitcoin ETFs have reached nearly $10 billion since Election Day. The total assets from funds like those issued by BlackRock and Fidelity have reached approximately $113 billion, according to data compiled by Bloomberg. President-elect Donald Trump's embrace of the crypto market has produced the boom in the market, with Bitcoin topping $100,000 last week, though it has now fallen below that. Meanwhile, spot ETFs for rival cryptocurrency Ether have also turned heads, attracting nearly $2 billion in net subscriptions. And it's the end of an era for Taylor Swift. The singer ended her Eras tour in Vancouver last night after 149 shows spanning 5 continents over 2 years. The concert series was the first to collect more than $1 billion in revenue, selling more than 10.1 million tickets. Swift ended the tour by thanking the crowd for being a part of what she called the most thrilling chapter of her entire life to date. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the bulls broadening out.
The other thing is broadening out a little bit, looking at small cap U.S., for example, which might have a little bit less vulnerability to some of these global crosswinds.
That's coming up next. This is Bloomberg Surveillance. Right now, we're getting toward the market open with a range-bound market after 3 straight weeks of gains, 57 record highs. A question of just how much better this market can get in 2025. Under surveillance this morning, the bulls broadening out.
Right now, we still are on the momentum bandwagon also. I mean, what worked well in 2024 is likely to persist in 2025, and that suggests that U.S. large cap in particular has room to run here. The other thing is broadening out a little bit, looking at small cap U.S., for example, which might have a little bit less vulnerability to some of these global crosswinds.
Here's the latest. Some investors expecting big tech's AI-driven run to broaden out to small caps next year. Kevin Rosenbaum of Cambridge Associates writing, we do expect small caps will outperform. It has been a rough couple of years for this asset class, but in our view, that is a nice setup for the future. Right now, Kevin joins us. Kevin, thank you so much for being with us. Before we get there, overall, you actually don't have as rosy a view as everybody else and thinks the impressive run of U.S. equities can't continue. Why?
Yeah, I think that's right. Look, U.S. equities have clearly been on a tear recently. They may finish up 30% this year after finishing up 26% in 2023. But returns have really been driven by a narrow collection of stocks, as we all know. And in our view, narrow stock leadership is fragile stock leadership. So we expect U.S. equity returns to moderate in 2025, certainly not calling for a downturn here. Just think that returns will be much more typical than the stellar returns that we saw in 2024.
Well, Kevin, you still see global equities as a whole outperforming, especially outperforming bonds. So if U.S. leadership wanes, what takes the reins?
Yeah, I think the way we think about it is that international equities, the gap between international equities relative to U.S. equities will kind of more moderate, and that global equities will just in general have a pretty typical year. You know, for us, when we're thinking about our asset allocation, we're really trying to understand whether or not global equities will outperform bonds. And for next year, we really do think that's the case. And that's what's informing our asset allocation across our institutional and family clients.
As we get,
well, let's be frank. Go ahead.
No, sorry, Kevin, continue.
Let's be frank. I mean, it's easy to be nervous right now. You know, clearly there are multiple armed conflicts going on in the world. There are rich valuations, and there's a lot of uncertainty with the new U.S. administration coming in. But if you look back at history, you know that global equities tend to outperform bonds in any given year roughly 2/3 of the time. And in our view, global earnings expectations for next year are reasonable. They're not out of line. And we also expect that risk sentiment next year will remain healthy, which should support valuations at the current level, because we do expect excitement over artificial intelligence to continue. And we do expect lower policy rates, which to us suggests that the marginal buyer will be a little bit more interested in equities over bonds. So we do expect global equities to outperform bonds in 2025.
Well, the biggest concern, according to Bank of America, when it comes to credit investors is geopolitical risk. Is that your biggest concern for next year?
It's certainly a considerable risk. I mean, the developments over the weekend were stunning. But I think for us, what it underscores is a couple things. First, it's that political risk is obviously very high. We all know that right now. But it also highlights how difficult it really is to predict political events as well. And that reality is really why we see so few investment funds focused solely on political risk analysis. You know, in contrast, economic and market data are just much more plentiful and abundant. And that's really what we hang our hat on at Cambridge Associates. Having said that, you know, I think the best move right now for most investors are not to make rash decisions in light of the weekend's developments. You know, markets have an amazing ability to just shrug off events and continue to march up.
Kevin Rosenbaum of Cambridge Associates, thank you so much for being with us as you look out ahead to 2025. And right now, looking out over the next week, all eyes very much on Wednesday with CPI coming up, the data that people have been waiting for, Danny, to try to understand how much of a risk inflation truly is.
And that's because this market has had such a short-term focus. That's why it's been able to overlook what might happen with tariffs, what's happening geopolitically, because they look to this month and they say, we are going to get cuts. So if you get a hot CPI, that's the thing that could undo it. So in terms of short-term risk, it's hard to see anything past Wednesday.
Torsten Slok last week was talking about how this Fed has had a bias to the labor market. And depending on the CPI report this week, I wonder if that bias starts to change.
Yeah, although Friday's NFP kind of was another Rorschach test, where basically some people were saying it's a sign of strength, other people saying it's a sign of weakness given the unemployment rate rising. So another kind of choose your own adventure at this point, Danny.
And as long as we get choose your own adventure, stocks can get higher. They need clearly a really big signal. If you can have governments around the world collapse and we're still buying U.S. stocks, you can have China hitting out against Nvidia and still this market is going higher. You need something else to wake everyone up.
Well, maybe this will wake everyone up. Peter Oppenheimer of Goldman Sachs, don't miss this. That's coming up, as well as Tim Adams of the IIF, Andrew Hollenhorst of Citi with his still more bearish view on the economy, and Christina Campmany of Invesco. From New York, this is Bloomberg Surveillance.
The fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points.
It's likely that a pause in early 2025 is warranted.
If there's too much focus on let's keep unemployment low, that it takes the eyes off the ball of inflation.
The real challenge is going to be what do they do if inflation starts to go back up?
Prudence, I think, is demanded right now. Powell's in a slightly tricky spot.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to the third hour of Bloomberg Surveillance. 90 minutes until the opening bell, with basically a range-bound market ahead of a big week for economic data, as well as an ECB rate decision at the end of the week. We see basically this incredible wave of enthusiasm from equity strategists around the world, welcoming all of the incoming data as the soft landing they've been hoping for. A little bit of a downdraft today on the NASDAQ 100, but the outperformance coming from the Russell 2000, Danny, as people look forward to the idea that the Fed's going to cut rates on the heels of a rise in the unemployment and not necessarily have their hand pushed by inflation.
Yeah, look, it's just one day, but I do think small caps outperforming is notable because a lot of the enthusiasm we've seen about this market has been about tech. That's why you're getting calls, and you mentioned BlackRock. I thought this was so interesting. They basically said the business cycle is dead. It doesn't exist anymore. Because of AI, everything is rosy and sunny. We're going to have more expansion and productivity. You've had a lot of the bulls saying that this is the reason why gains can continue, that valuations don't matter anymore. They're pointing to tech, so we're getting a flavor of something a little bit different this morning.
John Stoltzfus in particular talking about 7,100 as his target for the end of next year, as people look forward to not nirvana, not this sort of absolute absence of geopolitical risk, but simply that adoption of AI. At the same time, notable that you're not seeing a bigger drawdown from some of what we saw transpire over the weekend, Emery.
Absolutely stunning, really, what happened in Syria in terms of how swift it was that Assad had been unseated and then fled to Moscow. So what you have now is concern zone, the region that Syria just becomes a vacuum, and it's unclear who can actually fill that void. And you have the memories of Libya and Iraq basically looming over a lot of these Arab states. Norman Rowell, though, says he's optimistic that some of these regional leaders could potentially really guide potentially a new Syria. This would mean a lot of questions for Russia and Iran, given their strategic advantages and what they hope to hold on to.
So it's sort of this sort of pulsating in the background, but otherwise climbing the wall of worry as people run out of reasons to really be worried and front load a lot of the potential good news. We'll get to that coming up with Peter Oppenheimer of Goldman Sachs as stocks post another winning week on the back of payrolls. Tim Adams of the IIF on the outlook for financials under Trump, and Andrew Hollenhorst of Citi on why a Fed cut next week is all but certain. We begin this hour with stocks mostly flat. The S&P 500 and NASDAQ closing at fresh record highs on the back of a reassuring November payrolls report. Peter Oppenheimer of Goldman Sachs staying cautious, saying we remain modestly pro-risk in our asset allocation with friendly baseline of stable global growth, further declines in inflation, and continued central bank cutting cycles. A key challenge is markets are already pricing a more friendly macro backdrop. Having said that, we think equity drawdown risk is limited. I love this. Not really bearish, but maybe not as overbold as other people. Peter joining us now. It is so good to see you in person, Peter. Thank you for being here. I want to start with what it means to be constructive, but not necessarily over your skis, enthusiastic and buying in.
Well, I think that there are two things in terms of the context here. One of them is absolutely the backdrop, I think, from a cyclical perspective is positive for stocks. You know, if we look historically at times when we've had a soft landing, and that's been our expectation for a long time, and interest rates coming down, stocks tend to do well. But, of course, they've already done better than they would have normally done running into this interest rate cutting cycle. I mean, if you look this year alone, the S&P has had one of its best years since the late 1920s, and even that doesn't really fully reflect the scale of the rally we've seen, because it didn't start at the beginning of this year. It began in October last year. So we have high valuations, a lot of good news is priced in. I think the setup is positive, but at the index level, we don't expect to see huge rises. What we're looking for is broader returns and a focus on diversification to improve risk-adjusted returns. So that's really what we're looking to do.
Are you basically making the argument, to Danny's point, about the AI cycle that has infused a lot of optimism across Wall Street, that you think that maybe people are overplaying the further gains that some of the AI behemoths can make, and that really now it comes down to understanding the application across sectors? Yeah, I think that the AI story is real, and there's good reason to be optimistic about productivity gains. But the main players in this space, which are, of course, huge in the index, have record high concentration in the US market. They're now spending vast amounts of money on capex, and therefore their future growth rates are likely to moderate relative to other parts of the market. And indeed, if AI is going to be as
revolutionary as the optimists hope, then there are other parts of the market that are also going to benefit and participate in that. And I think this is another reason to expect some broadening out of market returns, and also a reason to be a little bit more diversified so that you're less focused on very, very concentrated positions within the market in the US, or indeed even in the US market, which is now so dominant in the global index.
You have seen instances where investors have tried to pick through this market and say, okay, what else is going to benefit from AI? Utilities was another obvious example of this. What is being left out? What should also rally in this broadening if it is based on artificial intelligence?
Well, I think there's two things. One of them you mentioned earlier was mid and small caps. You know, there are certainly companies within the next level down of size that should benefit because they're either contributing or indeed will generate new products and services on the back of the capital investment that the largest companies are doing. And that is a sort of cycle that we've seen playing out, for example, around the internet in the late 1990s. But I also think that we have a symbiotic relationship now between large cap tech and infrastructure and energy, because of course these companies, to realize their ambition, are going to need to see huge amounts of increased energy production, more electrification, so that other parts of the market will be part of that process. And many of these have been left behind in the rally that we've seen in the last year. And that's another reason to look a little bit more broadly, I think.
Well, so another one of the reasons that you point to is why this rally can continue, or at least the drawdown will be limited, is central banks. You said that they should buffer, that they will buffer shocks. Is the Fed coming back? Because for most of the past 2 years, the Fed has said that easier financial conditions, i.e. stocks rallying, have been a problem for them.
Yeah, but that was in the context of significant rises in inflation, which are now easing. So I think the central banks are less conflicted, and there's an ability and indeed a good reason why interest rates should be coming down. That is going to be an important support, I think. But it will also be an important support for some of the weaker balance sheet companies or more levered companies that have been, again, left behind a little bit on a relative basis in the last year or so, when most of the returns have come through, at least in the US, and the largest, very strong balance sheet tech companies.
It feels like the market continues to price in all of the good policies that potentially can come out of Trump. But what about some of the bad policies, especially for places like Europe and Asia, things like tariffs? How are you thinking about how the incoming Trump administration might use tariffs?
Well, I think there's two aspects to this. There's the tariffs themselves, which are going to have a more negative impact, particularly on parts of Asia and Europe, depending on how and to what scale they're applied. And then also there's the inflationary impact that those will have in the US as well, which may moderate the extent to which at least long-term interest rates can come down. That's a risk for the market, given the current valuation. Our own view is that, at least in Europe, we will see more targeted tariffs, particularly on the auto sector. I think that is priced in. There is weak growth anyway in Europe, but it's also worth noting that a lot of European companies are very global. Many of them produce already in the US or are very highly exposed to the US market, but trade at much lower valuations. So I think that we would look at Europe and some of the other regions as part of this diversification process. Despite the weak growth we've seen in Europe this year, you're seeing a wide spread of return. I mean, the Spanish market is up 27% year to date.
So there are pockets in Europe.
There are pockets, exactly. And I think the strategy that we're trying to look at here is to find pockets of value that gives you diversification to improve risk-adjusted returns.
You mentioned Spain, so you like the periphery. Is that because the core is dealing with just political paralysis?
Well, it's been an amazing turn of events relative to the sovereign debt crisis that we saw in 2015-16, because then, of course, all of the weakness was in southern Europe, saddled by very high debt and therefore very, very weak growth. And now you're seeing southern Europe doing really rather well, at least relatively speaking. And the core of Europe, or northern Europe, generally is much weaker. And indeed, the political paralysis we're seeing in France and Germany is constricting or restraining them in terms of what kind of growth that they can achieve. Having said that, again, it's important when we look at Europe not to overmap domestic economic conditions. Germany, again, has very weak growth, But the market has done rather well this year. Now, it's true that some of that, again, comes down to composition of the index. But that's why it's very important, I think, sometimes to look beyond the index and the country itself and to really try and find pockets of value and growth opportunities. And we think there are a lot of those when we look around the world.
Peter, if the ECB cuts by 50 basis points on Friday, as Jeff Yu was saying earlier this morning, that's what they should do. Would you actually get bullish and even go overweight in certain sectors of the European equity sector?
Yes, I think so. I mean, we overall expect the US market again to outperform Europe, but selectively, I think there are going to be some areas, as there have been this year in Europe, that do very well. And we do expect interest rates to come down more quickly in Europe. The currency is weak and likely to weaken further, and that will benefit some companies. And you can find pockets of Europe. As I mentioned earlier, there are a lot of companies in Europe that have 60 or 70% of their revenue exposure to the US. That's roughly similar to the average company in the US, but the valuations are much, much cheaper. And interest rate cuts in Europe will help those companies, I think.
I say this at a time when there's a real question about whether inflation is truly under control in the United States. And we do get CPI on Wednesday at a time when Neela Richardson earlier this morning of ADP was saying we're kind of at this point where we don't know which way it's going to go just based on looking at the labor market. How much of a game changer would it be if there were true signs that inflation was sticky and this was not a Fed that had the luxury of cutting rates more than maybe once?
I think it is important, again, to recognise that we're coming out of a decade or more of unusually low inflation and, more importantly, extraordinarily low interest rates. You know, most countries have policy rates at zero or even in Europe below zero. 3 or 4 years ago, a quarter of all government debt in the world had a negative interest rate. I think that has now shifted permanently into an environment where we're going to get lower rates than we've been experiencing in the last couple of years, but not going back to the levels we were seeing previously. And for some companies in some parts of the market, I think that is going to be a restraint because the cost of capital is going to be higher. But that's also a reason, I think, to focus on quality companies with stronger balance sheets, with good business models that are well diversified, because I think many of those are going to create good compound growth over time for investors.
Peter Oppenheimer of Goldman Sachs. Don't be a stranger. It's so good to see you. Thank you for
Thanks
being
for
here. It's a good, real consensus right now that there is this feeling that the AI transition is going to be a real game changer. At the same time, a real question, Danny, about how much has already been priced in.
Well, I just go back to David Rosenberg, who is often a perma bear, saying that he's not throwing in the towel, but he thinks maybe markets are no longer irrational. That what we're pricing in for tech, it's not 2025, it's not 2026, it's the next decade. And that's why valuations, not that they don't matter, but you have to look at them through a different lens now.
Let's get you an update right now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. U.S. officials discovered American technology in Russian weapons recovered from battlefields in the region. Records obtained by Bloomberg reveal details about a clandestine supply chain linking Silicon Valley to Moscow despite the heavy sanctions in place. Suppliers to Russia's military have been able to acquire components from U.S. chipmaker Texas Instruments unbeknownst to the company. Russian distributors have managed to send thousands of shipments to military contractors, including from several companies under U.S. sanctions. Meanwhile, President-elect Donald Trump says he has no plans to replace Fed Chair Jerome Powell once Trump returns to the White House. Trump has previously said he should have a say in monetary policy and the setting of interest rates. The president-elect himself appointed Powell for the role in 2018, with his term set to expire in 2026. Powell, for his part, has said he doesn't expect tensions with the incoming administration. And the 2024 Formula One season has come to an end with Lando Norris winning the Abu Dhabi Grand Prix for McLaren. It was the 12th and final season for the legendary Lewis Hamilton with Mercedes, who's set to join Ferrari next year. CEO of Red Bull Racing, Christian Horner, sat down with Bloomberg's Giuliano Bersecchi on what he's looking forward to in 2025.
I think 2025 promises to be a really exciting year. It's the last year of this regulations. We've seen the cars and the teams converging in performance. There's now 4 teams, in Red Bull, in McLaren, in Mercedes, and of course Ferrari, that will all be competing for wins next year.
Next year's season gets going with the Australian Grand Prix in March. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Is that where John is right now?
I think so. The F1, right?
Yeah, well, either way, he'll be back next week. Up next, the morning calls, plus Tim Adams of the IIF and the outlook for financials under Trump. That's all coming up next on Bloomberg Surveillance. Markets just about range-bound ahead of the open as we parse through geopolitics as well as potential for an upside surprise on inflation coming out Wednesday. Also a downside surprise. There just have been a lot of talk this morning about the upside potential. Time now for the morning calls. First up, Bank of America downgrading AMD to neutral, seeing more competitive risks in AIs against Nvidia's dominance. Next up, TD Cowen upgrading Blackstone to buy, expecting the investment manager to benefit from constructive themes in 2025. And finally, Morgan Stanley upgrading Jefferies to overweight, seeing the company as a significant market share gainer. Sticking with the financials, the sector reassured by President-elect Trump's eco-picks, including Scott Bessent for Treasury Secretary and Kevin Hassett for NEC. Tim Adams of the Institute of International Finance saying this: we'll likely see burgeoning M&A activity with an improved deal-making landscape. Personnel is policy. Anne-Marie says that all the time. So we'll see who comes in at the regulatory agencies to learn more about the future of regulations. Tim joins us now. Tim, thank you so much for being here.
Great being here.
So do you see right now the banking sector is really driving a lot of the optimism in the financial space going forward?
Sure, and they're hearing it from their clients. Animal spirits are back in the U.S. The outlook is, for the near term at least, is pretty bright. There's a sense of deregulation across Europe and the U.S. We'll see how much of that actually happens. But, you know, there's a sense of optimism that we haven't seen in a while.
Does that optimism, is it mostly centered, or should it be mostly centered on the largest American banks or the smaller ones?
Oh, I think it's across the board. I think Main Street and Wall Street are going to do well over the near term. But Wall Street looks at the near term with great optimism. I think deal flow is going to pick up. We're going to see IPOs, we're going to see M&A activity, and that's good for our institutions.
I know you're concerned, though, about the deficit. So you took kindly to the fact that there's some deficit hawks when it comes to personnel as policy. But over the weekend, Trump said that he's not going to cut Social Security, entitlements, not going to raise the retirement age. How are you supposed to get the deficit down?
Yeah, it's very hard because most of what you just described, if you look at social insurance and defense and net interest on the debt is about 90% of what we spend. The rest is kind of a rounding error. We can grow, and I think Scott Bessent, who's going to be the next Treasury Secretary, is focused on growth. That's good, but we're going to have to find ways to find savings. Deficit hawks are gone in Washington. They don't exist anymore. And maybe you need the markets to send us a signal. It's time to become more sober in our fiscal outlook.
Tim, you've spent a lot of time focused on the structure of the financial system in the United States, and by all accounts, it's really strong and it's diversified. There's been a lot of discussion around mergers among smaller banks and how much we could see if there is an administration that is amenable to that kind of tie-up. How much could we see?
I think you'll see a lot. I think you end up seeing a barbelling. The largest institutions get larger and the mid-size become larger. It's a scale business. Look at JP Morgan spends $17 billion a year on technology. Jamie probably would spend trillion if he could. But think about the tech spend that these institutions put in place and who they're competing with. And then you'll see smaller local institutions that know the local market. So it's a bifurcation. The mid-sized guys are going to get bigger.
Well, you raised this question. Who are the big competitors? Is it Apple? Is it
absolutely.
Google? Or is this an issue of, say, the Apollos of the world? And this has been sort of the two-sided barbell at a time where potentially fewer regulations for the largest banks could make them more competitive against both.
Yeah, I'd probably meet 200 CEOs a year in the financial sector. We hear a lot about private credit and private equity. We hear a lot about Apple, Google, and the tech platforms. And if you're Jamie, you're trying to compete with the tech platforms, right? And then maybe you can acquire or partner with private equity and private credit.
I'm really curious what happens to Europe in all of this. Yeah. If you have this growing American banking system, if the biggest get bigger, and they're not just eating the smaller banks' lunch, they're taking it from Europe too, which has been really struggling and has tried Unicredit, Commerce, trying to get some sort of merger through. Does something need to change? Will it finally start to happen?
Absolutely. Core Europe is on its back politically and economically. German economy is really struggling. The periphery is doing much better. Spain, Greece, Poland. But Europe needs banking consolidation. They need capital markets union, banking union. There's so much that this new commission and this new parliament needs to take on. They're saying the right things, but we'll see. It's time for action across Europe.
We saw UniCredit try to do that with Commerzbank, and the Germans really did not want that to happen.
Yeah.
What could give the boost to these countries to say, okay, we should start consolidating?
Well, you're hearing it from Christine Lagarde out of the ECB. She's signaling you need consolidation. You need Brussels to say it's time to act, it's time to consolidate. I think this deal is going to go through over time, and I think we'll see more over time as well.
Hold on a second. You think that the Germans are going to be okay with an Italian bank taking over one of their national champions? Let's underscore that.
They already have. The Italians have already taken over. They have no choice, right? These are great institutions. I like Commerzbank. The CEO, Bettina, is wonderful. I think they all realize that to compete domestically and internationally and compete with U.S. firms on the continent, they've got to consolidate.
Tim, you talk with a lot of regulators, you talk with a lot of elected politicians, and I'm curious about whether you've really heard a change in tone over in Europe that recognizes how different this moment is that they're in.
I think the Trump shock has gotten their attention. I think they know they have to do more, but Brussels is a challenging place, you know? It's a bureaucratic machine. So you need political leadership right now that's missing in France and Germany. Hopefully in 6 months we'll have greater stability. Brussels needs to act. Frankfurt needs to act. We need to see political leadership.
Where is the political leadership right now in Europe?
Missing.
At the G7, it felt like it was Giorgia Meloni that was almost this central figure of Europe, because everyone that showed up was either a lame duck or on their way out.
Well, the Poles have the rotating presidency, the EU. They're very pro-growth, and I like what they've done with their economy. I like where they want to go. Spain is saying, look at us, we're growing fast. And Greece, you know, which was always sort of the stepchild of the EU for so many years, is now really putting in great performance. I think what you'll see over time, core Europe figuring out they need to lead and do more. And Germany is the secret and the key to the future of European growth.
So you've done on this whirlwind tour of the whole world. You're coming to an end. I'm sure you're very happy to be going home.
Yeah.
What's your big takeaway, Tim, after meeting with international leaders of finance around the world?
You know, there's enormous optimism about the U.S., but there's concerns. There's just so much we don't know about what this new administration is going to do. The economic leaders that have been put in place, the personnel's policy, have really buoyed that outlook. But ultimately, how will these different policies be put in place? Will we see tariffs? Is it selective, incremental, or is it much broader? We just don't know.
Tim Adams of the IIF, thank you so much for being with us. Good luck and congratulations on making it home. Coming up next, we're going to be speaking with Andrew Hollenhorst of Citi and Christina Campmany of Invesco. Right now, I'm looking at a market that is reeling with the policy uncertainty, Emery. I mean, we keep hearing that time and time again.
And also, to Tim's point, it's the sequencing as well. Tariffs, are they targeted, are they blanket, but also are they coming first, or is it going to be maybe after the good stuff like tax cuts?
Meanwhile, we talk about mergers and acquisitions, and we see a whole host of them this morning, including in the advertising space, including when it comes to energy, and you just have to wonder how much more of this is pent up.
And this is why the big banks are going to do well, because that M&A advisory revenue fee is just going to go straight back to them. So you get mergers and you get M&A, the animal spirits are back.
Which is the reason why people are really bullish on financials, in addition to fewer regulations. Really interesting point there that Tim was making in terms of who are the big competitors. Is it really the Googles and the Apples, is it the Apollos, or is it just yes as they move forward into a brave new world of finance? Right now, you're seeing markets basically range bound, a little softer after 3 straight weeks of gains. This is Bloomberg. A little bit of softness. I don't want to overstate this ahead of the open, but turning around as the session grows older, as it is wont to do after 3 straight weeks of gains and 57 record highs. This is a market looking for direction. Although you are seeing one when it comes to the small caps, up 0.4%, 1 hour away from the cash open. Here is your morning movers with the one and only Manus Cranny. Manus.
Lisa, good morning. There's certainly an appetite to do deals. Isn't it? We're going to go to a new regulatory environment. You've got Interpublic up and strongly bid this morning. Omnicom in talks to do an all-stock deal with them. How do you create a $20 billion revenue behemoth in the advertising business? That is what we are talking about. Trumping WPP in terms of size and scale. There's 2 sides to this, as always. There's the bid side, which is efficiency, technology, and there's the offer side, which is people leave. People get fed up when you do mega mergers. Sometimes your real producers just leave. They go, I don't need to live through this experience. Either way, there's a shift in the thinking in the C-suite about doing deals and getting it through. So Interpublic is bid this morning. Palantir teams up with Anduril. Think of the weapons industry. This is about smart defense. This is Palantir taking the AI capability, overlaying on the top of the weapons maker. So you think sensors on vehicles, on robots. It's about making smart decisions going forward in terms of defense. Peter Thiel is a backer of both of these companies. I'm sure he's smiling this morning. This company's worth $173 billion. That is more than Lockheed Martin. That just shows you the acceleration in technology with defense. Close it off with Nvidia. You've spent time talking about this morning. Why now? Why are the Chinese now investigating an acquisition done in 2020 that they signed off, which was Mellanox? Now, look, this was all based on the supposition that Mellanox would pass their new product information back to the Chinese within 90 days. Either way, this $7 billion deal is now up for discussion. There's no shock. As the US and as Washington ups the game in terms of tariffs, the Chinese are reacting both on monetary policy, fiscal policy, and in ground zero, which is Nvidia. Lisa.
Thank you so much, Menace. Great work, as always. Right now, let's turn to the labor market. The November payrolls report showing moderating conditions with a solid top-line number, but unemployment ticking up slightly to 4.2%. Andrew Hollenhorst of Citi saying the unemployment rate is the better signal to watch. The report was not quite soft enough for the Fed to cut 50 basis points as we had projected for December, but a 25 basis point cut appears very likely, followed by cuts in January and subsequent meetings. Andrew joins us now. And Andrew, I am so glad we get a chance to speak with you because you have a contrarian view and you have persisted in this contrarian view that this labor market has a great deal of weakness that people are not seeing. What gives you that conviction now, even though it has been a while since we've seen really some of the confirmation in the headline numbers?
It's been really noisy data, and so I think that's part of the issue with analyzing the labor market here is you have to make some decisions. You have to take a stand on which data are giving you the correct signal about where the labor market is going. To give you a sense of the contrast, if you look at the payroll survey, the establishment survey of businesses, that's telling you we've added 2.2 million jobs over the last year. It sounds like a great number. On the other hand, if you look at the household survey, you call people at home and ask them if they're working, we're down 725,000 jobs in that survey. That's typically what you would see going into a recession. So which is the true signal? Of course, we don't know, and you have to put some weight on each. You have to have humility in terms of analyzing this data. But if you look at that payrolls number, we know from the revisions that the business survey, establishment survey payrolls are being overstated. So every month when we get that number, we should be subtracting something like 70,000 jobs per month from that number. So that is the overstated number. The household survey, which we think is giving us a better indication of where the labor market is running, is telling us that we may actually be losing jobs here. So we continue to have this softening trend in the labor market, the unemployment rate that's rising, and I think that's the trend we should be watching.
If that is the case, how much can you discount the idea that the number of hours worked has actually inflected upwards, and that when you pair that with some of the wage gains that we've seen, that's when some of the inflation concerns start coming back in?
Yeah, I'm not too concerned about inflation cyclically because of the softening that we have in the labor market. Now, what you're saying is correct, that we have a strange labor market where businesses are hoarding labor right now. So we're seeing a hiring rate that's very low, but we don't have a layoff rate that's rising, right? We don't have hours worked that's plunging. It's come down, but it's not falling further. Wage growth, which has slowed, but it's been a little bit stickier at a higher level. So this is a different labor market than what we've ever seen before. I think these things can be happening together, where you have firms that are reluctant to hire, firms that want to hold on to their current employees if they can, but when they lose those employees, they're not backfilling them. And what that means is you don't necessarily have a higher probability of losing your job right now, but if you do lose your job, you have a higher probability of not finding one again. And that's going to affect consumer behavior. That's going to affect the broader economy.
Does that mean that there isn't really a number, outside of what would be normal, that we could get on Wednesday that would mean that the Fed shouldn't be cutting? Should the Fed really be cutting regardless of the CPI figure we get on Wednesday?
Yeah, I think we have to go back to an environment where the Fed, central banks are balancing risk to inflation and risk to the labor market. So it was easy to say a year ago that, well, inflation's running very high. That should be the complete focus. And I think we're still fighting the last battle a little bit here. So yes, inflation has been sticky. Inflation hasn't come down as nicely as some people thought that it would. But you also have to look to the labor market. So we have inflation that looks to be running maybe closer to 3% than 2%. I think it's going to continue to slow based on what I'm seeing in the labor market, but that's a projection, that's a forecast at this point. But you have to trade that off with looking at the household survey. 725,000 people are not working now.
Do you think the Fed has that message? It's this whole what they should do versus what they will do. Do you think that there is a number that for them would cause them to stop the cuts in December?
I think December they're probably going to cut, even if we get a strong CPI inflation reading. I think this would be more about what are they going to signal for January. Right now, I think we'll get a softer report on Wednesday for core CPI inflation. I think that's going to make the decision very easy. But if we don't, if we get a stronger reading, then what you would see them do, I think, is still cut in December, but say, we might be at that point where we would slow the pace of cuts. They've been using this really open rhetoric of saying we're going to be cautious, we're going to be careful. Of course, every central bank is going to be cautious and careful. You can cautiously cut 50 basis points, right? It doesn't really mean anything. So we'll see what they say in December.
Okay, speaking of January, we're going to get a brand new Trump administration coming in, a Republican sweep. And Trump yesterday on Meet the Press was talking about immigration in the first 100 days. You're talking about the fact that what's going on in the labor market. How tight could the labor market get if we do see things like mass deportations?
One of the things he talked about in that interview was that this is going to start with those immigrants that have a criminal history and that's going to be the focus, at least initially. So Lisa was talking about this idea of sequencing. What's the policy sequencing? So if that really is the focus, that's not something that's going to have a big effect on the domestic labor market. Now, we know that a large percentage of workers in this country are working without authorization. So if you had a large deportation program, then you could have issues where firms are trying to hold on to their native workers. That could tighten the labor market. So you do have that risk. I think we have to watch how that policy plays out. But based on what I heard over the weekend, that's not making me more concerned about an inflationary impetus from that
The other risk, of course, is tariffs. And potentially the Fed might have to think about what that means for inflation next year. How are you thinking about tariffs? Are they a negotiating tool? Are they blanket?
I think they're on two tracks, and I think we've already seen tariffs as a negotiating tool. We saw tariffs floated for Mexico, for Canada. Those tariffs are probably not going to come into effect. They're meant to be a start to negotiating things related to immigration and fentanyl, right? Non-economic issues. The across-the-board tariff is on a separate track, I think. I think we will see some form of that. That would, if you're increasing the cost of foreign goods, then some of those costs could pass through into consumer prices. But we've heard from Fed officials is that they're going to be quite slow in terms of taking their time and watching how this plays through in the economy. And remember, from a central bank perspective, if you put that tariff in place, the first instinct of central bankers is to say, that's a one-time rise in the price level, and we don't respond to a one-time rise in the price level. So I don't think this is something that's going to make the central bank, make the Fed a lot more hawkish.
I guess one thing that AMH is trying to get at, and I think it's the right thing to get at, is what would make you rethink the thesis if we do see, say, an increase in inflation from policies, or just if CPI comes in hotter than expected, what is it that would force you to look at a different set of considerations in your employment template?
Yeah, if I see growth that's accelerating, if I see job growth that's accelerating, the unemployment rate that's coming down instead of coming up, we have wage growth that's picking up, and we're starting to hear firms say, we have a lot of pricing power in this market, we can raise prices. And that's all the opposite of what we're hearing right now, right? We're hearing firms say, even when we cut prices, we're not getting the kind of sales that we were expecting. So that's why I think we're in a down trend in terms of inflation. If those things inflected, then you would get worried about higher inflation.
Do you still see a very big risk of recession?
I think recession risk is elevated. It's certainly elevated, and so I would disagree with Fed officials that it's not elevated. When you have the unemployment rate that's up by almost a percentage point and you have very low hiring rates, what you worry about is this going to move over into layoffs? We haven't seen that yet, and that's a very good thing, and it looks like maybe this could continue some time without getting that pickup in layoffs. But is that risk elevated? I think you have to say it's elevated. And I would also say very high valuations in equity markets. It doesn't mean that we have to have a sell-off, right? But does that make the risk more elevated, that we would get a correction in risk assets, and that could drive somewhat of a slowing in the economy, I would worry about that also.
Andrew Hollenhorst, always wonderful to speak with you. Thank you for being with us. I love to hear the contrarian view and a different way of looking at the data, because it really has been a Rorschach test. Meanwhile, investors looking ahead to the final set of inflation data before next week's Fed decision. CPI due out on Wednesday, PPI on Thursday. Anna Wong of Bloomberg Economics joins us now. Anna, is your view that essentially an upside surprise to inflation seems to be the base case in some of the whispers you're hearing among your colleagues?
Yeah, because I think the key item to look for is used car prices. And it seems like this used car price reading is going to be elevated. And I think, as Andrew mentioned, the broader trend is for disinflation because companies are losing pricing power. So that's not something you need to worry about. But looking forward in the next couple of prints, I do worry that the core CPI is stuck at 3.3%. We expect this coming print to show a third consecutive month of stalling year-over-year core CPI reading. We expect the same reading in December. So basically, by December or by the January FOMC meeting, the Fed will have 4 CPI reports or core PCE reports where the year-over-year reading is actually ticking up, and we expect core PCE to tick up to 2.9% in the last 2 months of the year.
Anna, Omar Sharif of Inflation Insights points out that the wild card for this report is owner's equivalent rent, specifically New York, because prices reset every 6 months, and we now fall into that 6-month period. What are you expecting when it comes to shelter costs?
Yes, the risk I see with shelter costs actually happens in January. So BLS did explain how they're resetting the weights of owner's equivalent of rents. And particularly concerning is that the weight for single detached homes may likely be revised up. And we have seen that the rents in the housing prices in single detached homes have been more elevated than the rest of the housing market. So we may see a rerun of what we saw in the first 3 months of this year, where OER suddenly spiked up, pushing the core PCE and core CPI up.
Anna Wong of Bloomberg Economics, thank you so much for being with us. Christina Campmany of Invesco weighing in on what happens after next week's Fed meeting, writing, following a December ease, the future path of Fed policy is quite uncertain. Given the underlying strength in the U.S. economy, the Fed is likely to pause after December. Whether they ease again in March or not will depend upon the evolution of policy initiatives as well as underlying economic data. Christina, I'm so pleased to say, joins us now. Christina, before we even get to next year, I'm just curious how important it is to really look at CPI on Wednesday, especially given what we were just hearing, that there is sort of a certain bias for it to surprise to the upside.
Look, I think that the Fed is taking every data point as it comes, and it matters just like the payrolls report mattered, but I don't think it changes per se the outcome of the December meeting. And I think they look about taking stock of let's get 100 basis points of easing under our belt and see where we are. And there's so much uncertainty, whether it's the policy evolution or some of these seasonals in CPI that we're expecting to get in the early part of next year too. I think there's a lot that they have to work through. So they are data dependent, but I don't think that necessarily means that the data print 6 days before changes that meeting. It changes the path.
How much have they lost the upper hand when it comes to driving the narrative? And I ask this at a time when they don't have a crystal ball. They can't understand where exactly this economy is going to break or reaccelerate. And we're looking at a market that's actively trying to figure that every day and has come to a conclusion that seems reasonable. Do you just follow almost the status quo more than you do, say, some proclamation from the Fed?
I think there's a little bit of both. Look, I think the Fed is grappling with the same uncertainty and questions that everyone in the market is. And they're trying to say, what is our end game, right? Like, we are trying to maintain this soft landing. And the Fed has done an incredible job so far of doing that, right? Like, over the last year and a half, how many times have we had recession calls and all of this? And we continue to have an extremely resilient U.S. economy. The labor market is slowing, but that's what the Fed has wanted to manufacture. And now there's some noise in the inflation data, but I think when we take a step back and at 10,000 feet, we're moving in the direction that the Fed wants us to be going.
But part of the issue of the uncertainty, at least because it's happening now, is because now is the period where everyone feels the need to say, hey, here's what we think is going to happen in 2025. And there's so many uncertainties. I know one of the things you see going forward is steeper curves. But how much could that get short if the cutting cycle also needs to get cut short?
I think a lot of that has changed already. So I think at the end of the summer, when there was real concern about the U.S. economy breaking more and the Fed needing to cut to and through neutral, there was a lot more scope for the curve to steepen. From here, we still think there is value in the front end, and you've had so much work you've flattened the curve a lot, but you've had a lot of work of repricing the front end too. You're getting pretty close if you get an ease this month that twos are flat to policy rates, and you take out the negative carry in the front end, and I think that gives people some comfort. So is there the same, are we talking about 100, 200 basis points of curve steepening? Certainly not. But I think that there's still a case for a steeper curve from here.
That's the front end. On the long end, I mean, there have been all these fiscal concerns around the election, and you saw yields go higher in the immediate aftermath. Since then, I mean, flat as a pancake. What gives?
We've had the same questions and conversations. I think there's two things that the market's grappling with. One is Doge and how much efficiency and savings are really going to come. And I think that there's a lot of, I don't know how much hope there is, but I think that there's a lot of, this is a question mark, and there's a potential difference than what we were considering before. And the second is, I think the market has taken a lot of comfort with Bessent being named as Treasury Secretary, and that this is more of a conventional player. But we will still see, right? Like, Trump has said that their policy initiatives are tariffs, deregulation, immigration, taxation. What is the order we get? What is the magnitude? How quickly do we get them? All of these things will matter, because at this point, you've come out of the election and you have some animal spirits and you have the uncertainty removal and you already have strong growth. We think that is still a positive tailwind, at least for the first half of 25.
What is it about Doge that you think the market likes? Because the president-elect said yesterday he's not going to cut things like Social Security, Medicare. This is the biggest pie of the budget. We're talking about $5.3 trillion that were spent on Social Security, healthcare, defense, veterans, net interest payments. So where exactly can they cut?
Look, I think the market is probably a little more optimistic than we can just buy into ourselves. I think you've also seen this across administrations, across history over the last 50 years of people saying, we're going to make the government more efficient, we're going to cut costs. Will there be the ability to do it? Let's see. And it's been bipartisan. You've seen both sides of the aisle try to do this. But I think there is the hope, especially with we're bringing in business people who this is their bread and butter. Let's see what they can do.
I want to end on the most important note, which is Treasury auctions. We have 3 of them this week that are getting people's attention. 3-year notes tomorrow, 10-year notes on Wednesday, and 30-year notes on Thursday. And it goes down to the crux of all of the lack of knowledge that we have about the murkiness of 2025. Which of the denominations would you most want to buy? What are you watching for in some of these auctions?
Look, so we're still happy kind of structuring portfolios with front-end, higher-yielding securities. So I'd say that's our focus. And again, I think there needs to be some premium out the curve, certainly in 10s and 30s. And that's countered with the backdrop of you have U.S. exceptionalism. That story is what's anchoring us, and you have global desynchronization, especially with all of the geopolitics. So I think there is certainly, we've continued to be impressed with the backdrop and anchor for support in the U.S. market, but we'd rather be in the front end.
Okay, so what would it take for you to be interested in the long end?
I think, again, some more clarity on where we get policy-wise, and I think you get towards 475 in 10s, you get towards that upper range, then maybe you can start to put some money to work there, too.
Christina Kentmany of Invesco, thank you so much for being with us. Great to see you. Right now, let's turn to everything else going on this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. South Korea's Justice Ministry has banned President Yoon Suk-yeol from traveling overseas. The ban coming as multiple investigations are underway following the embattled leader's brief declaration of martial law. He survived an impeachment vote over the weekend. The Kospi benchmark stock index closed down 2.8% today, and since the martial law declaration last Tuesday, it has fallen more than 5.5%. And the search continues for the suspected gunman in the killing of health insurance executive Brian Thompson. Here's the latest. The New York Police Department released new images of the suspect in a taxi that's believed to have taken him to a bus station. From there, police believe he boarded a long-distance bus out of New York City. The photos were released. New photos were released after a gray backpack was found in Central Park, matching the description of one carried by the gunman. In it, a jacket and Monopoly money were found, according to people familiar. And exciting news in baseball, Juan Soto is heading to the New York Mets. The 26-year-old slugger signed a 15-year deal worth $765 million. That's the largest signing in pro sports history, topping the blockbuster 10-year contract Shohei Ohtani signed with the Dodgers last year. The Soto sweepstakes had been in full swing for weeks, with a number of big-name teams in pursuit, including the Boston Red Sox, Los Angeles Dodgers, and Yankees, who Soto helped bring to the World Series this past season. That's your Bloomberg Brief. Lisa?
Yeah, Hira, thank you so much for this morning. I really appreciate it, especially for underscoring the Juan Soto story multiple times, because it really is.
I don't know why
wonderful.
the story. Why is it twice this morning?
Steve,
this is a biased show led by Brahma this week.
Thank you. Meanwhile, up next, setting you up for the week ahead. Not this, although we can continue this. This is Bloomberg Surveillance. The longer you wait, the more likely stocks are to keep going up, clawing back some of the losses, if you can call them losses. Basically a range-bound market after 3 straight weeks of gains. Counting down to the opening bell, here's the trading diary for the week ahead. After the closing bell, Toll Brothers and Oracle reporting earnings. Tuesday, OPEC holding its year-end conference and auctions. Wednesday, CPI plus results from Macy's and more auctions. Thursday, PPI and another round of jobless claims and more auctions, plus an ECB rate decision as well as Costco earnings. Coming up tomorrow, don't miss this. Peter Scheer of Academy Securities, Jill Carey Hall of Bank of America, Emily Rowland of John Hancock, and Port of Los Angeles Executive Director Gene Soroka. As we finish up the year, as we head into CPI, Danny, what are you watching?
I'm just watching the enthusiasm that we have for this market, and considering guests today, enthusiasm but geopolitical risk, enthusiasm but policy risk for 2025. You can be bared up, but people are giving themselves kind of an out to say, it might not all be sun and roses.
Yeah, and they have every reason to, especially these Bank of America surveys saying 30% of respondents are nervous about geopolitics. Well, look at the events over the weekend. We are seeing shifting narratives when it comes to the Middle East and what is also going on in Russia.
Yeah, massive changes, as we just heard from Norman Rule, just basically overturning the classic order that we have seen in the Middle East. This was Bloomberg Surveillance. Thank you for choosing us. We will be back tomorrow from auctions, lots of them. Have a good day.